Good morning. It's Wednesday, February 8th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Brian Sozzi. That's Brad Smith. Let's take a look at futures real quick here. As we get underway this morning, we are seeing a downdraft for futures, all of them down. I'll call it a third to a half of 1%. We're going to dig more into the market action. But first, here are the three things you need to know this morning. Inflation still a big factor in restaurant earnings. We've got the latest results from Yum Brands and Chipotle. We're going to break down what investors need to know from these reports.
Bob Iger returns to center stage tonight for Disney's latest results. Investors are going to be listening closely for the tone of the earnings call as Iger contends with an activist investor campaign and streaming woes.
And President Biden pushed back on stock buybacks in his State of the Union address. What investors need to care about from the president's address, we'll dive into it all. First, let's get started with the first thing to know this morning. Prices are still top of mind for inflation-weary consumers, which we saw in earnings from restaurant giants Yum Brands and Chipotle this morning. Yum Brands beat Wall Street profit estimates in the latest quarter as consumers remain lured in by Taco Bell's value offerings. Chipotle painted a slightly different picture, though, with sales cooling following a recent round of price hikes. So Chipotle's same-store sales, I think that's what the street is locking in here on up over 5%. That marked a deceleration in growth compared to the third quarter, which was about 7.6%. And if you drill into this earnings call, price. Chipotle raised prices over the summer, and it's not that sales completely fell off a cliff. Consumers appear to balk a little bit, and I think we also heard that to a lesser extent from McDonald's when they reported, but at the end of the day, you now have to start to wonder how much pricing power does not only Chipotle have in this environment left, but many other companies like it.
The common denominator between Yum Brands and Chipotle, restaurant margins. Margins are still getting squeezed because, yes, consumers are price conscious, but the restaurants themselves are paying higher prices still as well. If you look at margins at Yum, 15.6%, that was below what analysts had estimated. Restaurant margin at Chipotle, 24%, it was also below. What is still rising in terms of costs for these guys? Chipotle talked about the cost of tortillas, but something that both of them talked about is wages. They are still having to pay people, and the rate of wages continue to go higher. So that's something that continues to squeeze these companies. And P.S., by the way, that's the thing that the Fed does not want to continue to see go up. But we'll talk much more. We'll talk much more about that later.
I was ready to talk about the common denominator being the burritos and the tacos, but
there's that too.
There's that too. That's a given, right?
Food,
that's just on the menu. But this is also coming during a period of expansion that Chipotle talked about a little bit more on the call last night too. Opening 100 new stores in the fourth quarter, 90 of those having a Chipotle, and of course they've been known to lean into that digital touch point with the consumers, and they're on track to actually open 255 to 285 new restaurants in 2023. At least 80% of those are going to have a Chipotlane rather. So trying to really seamlessly deliver that digital experience to their customers, but at the time where the customers are clearly perhaps balking at some of the burrito prices that they may be encountering because of how those inflationary pressures are getting passed through them.
Well, that's why they're going to Taco Bell over a Chipotle. I mean, not that you're not talking about a one-to-one comparison. Let's be honest. Sure. Between the Taco Bell.
Hey, don't dump on Taco Bell here. This Taco Bell quarter with this Taco Bell same-store sales.
But people obviously went there. They love it.
Same-store sales up 11% for Taco Bell in the most recent quarter, and then a perfect scenario what you want to see from a restaurant, really any other company. Sales up 11%. Operating profit for Taco Bell up 24%. So in the case of Taco Bell, the items are so darn cheap, they can push through the 50-cent price increases. You're still going to leave out of there with a, $3-4 taco at midnight after a couple beers? I'm down for that. I could do it.
I'm waiting for the transcript of the conference call to hit. You know what 2 words I'm going to be searching for?
What's that?
Mexican pizza.
You like that?
You know what? I love the Mexican pizza.
So is Dolly Parton.
Yeah.
Really?
So that's the common denominator between me and Dolly Parton. There you go.
That's a very good one. I wish I shared that too. But, I mean, look, Taco Bell clearly running away with it for Yum Brands here. KFC was the next closest in terms of the full year performance that they had seen. Same-store sales up by about 4% there. Some system sales up by about 6%. And then Pizza Hut, that division was basically even over the course of the year. And then so going forward from here, how much more do they continue at Yum Brands to lean into Taco Bell, lean into the clear cultural shift that is maybe not a shift, but I think in the number of consumers that are looking for that value play, especially in the Mexican grill category, if you will, Taco Bell is it's a reliable categorical play.
What you're getting there. And from there, I will just add this on Chipotle. If you're an investor on the platform, you're like, what do I do with this stock here? They have still had success pushing through higher price increases. It's not everybody stopped going to Chipotle. And on that front, January sales for
Yeah.
Chipotle. It looks like they accelerated to low double-digit percentage gains. That is a huge increase, and it didn't come by them discounting. So that's quite positive.
Right, and also they said on the call they're hoping inflation is starting to moderate. They're seeing a few signs of that.
Yeah, we're going to continue to track shares of Yum as well as Chipotle, and stick around later on in the show. We're going to take a bite into Chipotle's earnings with the CFO. Chief Financial Officer Jack Hartung is going to join us 9:45 a.m. Eastern Time today. Let's get to the second thing that you need to know this morning. Disney, set to report quarterly results after the bell today. Investors anxiously await greater clarity from CEO Bob Iger. This is his first earnings report since his return. He came back like Michael Jordan wearing the 4-5. We're going to be closely monitoring this call this evening here, and perhaps we'll get a little bit more on the color around how he's going to be shifting the operations for Disney now versus what we saw with Bob Chapek and now for a brand and a company that is still facing a major activist campaign against us.
I think Big Bob better come back with the 2B, as in $2 billion in cost cuts, because I think the market really wants to see aggressive cost cuts from Bob Iger out of the gate. Does not want to hear him teasing anything in the back half of the year. They want a clear strategy for him because this is a company that stock price is massively, relatively outperformed. Hence, that's why you're seeing an activist campaign and Nelson Peltz trying to get on this board and his various people putting out tweets on Twitter to garner support for him getting on that Disney board. And I will say this again, he's got a strong case. But Bob Iger has to come out here swinging, and we'll see what he's got.
Yeah, and strategically, they want to know about the direct-to-consumer business. What is the strategy there? What does the profitability pathway look like there? How are they going to get net new subscribers onto growth there? Also, you know, investors want to hear Bob Iger talk about Hulu, talk about ESPN. What are the future plans for those as well? And I imagine there are also going to be some questions about the parks in a recessionary environment, or at the very least a slowing growth environment. You're talking about expensive parks, right? They've been raising the prices for the parks. If people are pushing back against the price of a Chipotle burrito, what are they going to do when it comes to the price of taking your family to Disney World or Disneyland?
And that is really hurting customer perception. I tweeted out a chart earlier in the week from Evercore ISI, and you can see the Net Promoter Score, which manages customer satisfaction with Disney parks. That is on a downtrend, and it comes at a time where they have pushed through higher prices increases, Julie.
Right, and perhaps some of that customer satisfaction is because of the fact that they have to pay more, not just to get into that experience for an entire family and the thousands of dollars that could rack up to over several days, but then once you're in the park, to try and make sure that you're taking advantage of that full amount of time. You're buying in to get the pass to get you to the front of the line, only to perhaps still be sitting in a fast pass line at the end of the day.
You're looking at over 10 G's to go to Disney.
Right.
At a bare minimum, to have a good time at Disney, probably what?
To get the turkey leg all in.
Just to have a reasonable time here.
I tried not to add it all up.
That's a car. That's a car.
It is.
Car, go shake the hands of Mickey and Minnie Mouse. I'm going with car.
I don't know about
I still have the autograph.
now I feel like I have to go back and retroactively do the math for my Disney trip a couple of years ago.
Do it. Follow up tomorrow.
Because I usually when I do these trips, it's just sort of like I don't add everything up. I just sort of.
Well, you could have had another car, Julie.
Yeah.
I mean,
Good.
well,
2 cars is good.
yeah. Well, just one other thing that we're going to be watching later on today is, to your point, Julie, on the streaming side of the business. There have been consistent media trend survey. Deloitte puts their media trend survey out every year. And typically the average household, even in good times, has about 4 to 5 streaming services. It'll be interesting to see if that is either helping Disney as that number starts to tick down to about 3 to 4, if people are just opting to say, we're just going to bundle it all together, or if they're saying, okay, we're only going to choose one Disney platform, we're going to choose one HBO, of course, the only HBO platform, one Netflix perhaps. And so all that in mind, that could be interesting to get a little bit more insight on, of course.
Also curious on what Bob Iger says about, if anything, just the cadence of key movie releases. There continues to be this ongoing debate. Should a lot of these key movies be released on streaming first and then the movie theater? And to that end, you're going to want to keep an eye on shares of AMC.
Absolutely. Well, stick around. Tonight, 5:30 for a vibe check. Yahoo Finance's Shauna Smith and I will be recapping Disney's earnings call and breaking down everything you need to know. This is my first time
I've
seeing
never
You have the
seen
Shauna
cartoon.
cartoon. Wow, that is
Yes.
amazing.
Looks good. All right.
And
We're looking forward to it.
I will too. And the third thing you need to know, President Biden took the House chamber last night for his annual State of the Union address, where he took stock of the country's progress over the last 2 years and ran through a slew of economic proposals. A key takeaway from the night for investors was Biden's focus on taxes and corporate stock buybacks as part of his push to be less favorable to the wealthy.
corporations ought to do the right thing. That's why I propose we quadruple the tax on corporate stock buybacks and encourage long-term investments. They'll still make considerable profit. Let's finish the job and close the loophole to allow very wealthy to avoid paying their taxes. Instead of cutting the number of audits for wealthy taxpayers, I just signed a law to reduce the deficit by $114 billion by cracking down on wealthy tax cheats.
Let's hone in on this and other takeaways for investors from the speech with Yahoo Finance's Rick Newman. Rick, I could talk all day about the theater of Kevin McCarthy shaking his head sternly behind the president while Kamala Harris rose to her feet and started clapping, but I won't. How likely are, if you look at the various economically related things that he talked about, Biden, in the speech, how likely are any of them to make it anywhere?
There was more theater than that, of course, Julie, with the cat calls from some of the Republicans in the audience. It was fairly interesting theater last night, but let's go back to these specific points. So Biden, a couple of the things he did call for, you heard there, he wants to quadruple the tax on stock buybacks. That tax went into effect for the first time last year as part of one of the bills Biden signed. Now he wants more revenue from that. He also called for an oldie but a goodie, which is a billionaire's tax. And none of these things are going to happen. So I think investors knew this going in. Biden is not going to get any democratically passed legislation for the next 2 years because Republicans control the House. So why is he bringing this all up? The speculation is that this is the beginning of Biden's campaign for a second term. So Biden may be campaigning for a second term in 2024 and using these same talking points. But, everybody should keep a few things in mind. Democrats did control Congress, both houses, during the first 2 years of Biden's presidency, and they could not pass an increase in the corporate income tax. That's something Biden wanted to do. They could not even repeal the so-called carried interest loophole, which is a tax break that mainly benefits private equity firms. They couldn't get that done. And there were almost no really significant tax increases at all during those first 2 years. So Democrats couldn't get this done when they had control of Congress. It's not going to happen during the next 2 years, and it's dubious whether it would happen if Biden won another term in 2024.
Yahoo Finance's own Rick Newman, thanks so much for watching the State of the Union, breaking all of this down. We appreciate it, Rick. Thanks.
Bye, guys.
All right, sticking with this conversation, President Biden struck an optimistic tone as he confronted a divided Congress in his State of the Union address last night, remaining determined even as he faced a series of confrontations and heckling from Republicans throughout his speech. Let's get a look at the overall turn and tone of the night and the big picture of Biden's State of the Union address with AGF Investments Chief U.S. Policy Strategist Greg Valera. Greg, great to have you here with us today. First and foremost, if you were to sum up what you did hear from Biden on the economic points that he was discussing last night, what grade would you give the president?
Well, he bragged with good reason. The economy is in pretty good shape. Unemployment is quite low. Inflation seems to be subsiding. The problem is people aren't buying it. Most Americans still, I think, are scarred by what's happened with inflation. They don't give him a lot of credit. And when he does boast about it, he runs the risk of sounding out of touch, not in touch with the ordinary American consumer who still is worried about the economy.
Greg, how worried do you think markets should be about the tone they heard last night from the president on the debt ceiling debate?
Good point. I think if anybody was hoping for any breakthrough on the debt ceiling, they didn't hear it last night. It's already becoming an acrimonious issue within the Republican Party and between the two parties. And I think that the scolding that both parties did is a sign of things to come. This convinced me that we're not going to get a breakthrough until summer, and both sides are bitterly divided on this issue. It's going to be a very long slog.
So this is interesting, Greg. So it sounds like you think, all of this talk from the president about a tax on buybacks, for example, his rhetoric against corporations, billionaires, et cetera, is that sort of a sideshow to the real battle that is going to be happening over the debt ceiling?
I think it was a gift to the populace who wanted to have an issue to campaign on. And I agree with Rick Newman, who earlier said it's not going to happen. I mean, there's no chance at all that any significant tax increase could ever make it through this House. There's no chance that we're going to go after the oil companies, but it makes for good headlines. It pleases the populace. Maybe it gets them a little political support, but it simply will not happen.
So, Greg, just to follow up on the debt ceiling then, I mean, the cynic in me who's watched these battles happen before says, in the end, in the 11th hour, they're going to get it done anyway. So, what's the point of markets worrying? What's the point of all of this theater? Do you think ultimately that's what's going to happen?
I think there's enough radicals in the House, many of whom were heckling the president last night, enough radicals who are determined to get really dramatic spending reduction, maybe an across-the-board cap. That might be in a final deal. But I think they are not going to relent anytime soon. It's only going to take half a dozen, perhaps, to throw a monkey wrench into any progress. So this is different. I think there's a better chance this could go right up to the last day or two. The markets are convinced that we'll get a deal. We probably will, but it might take something extraordinary from Jerome Powell. I think the Fed chairman would be aghast if he thought the U.S. debt would default, and he might have to take extraordinary action.
Greg, I'm also curious, if you look at some of the latest poll numbers, the president's not polling great, right? Especially if this is viewed as the informal kickoff to his next campaign. What could change that, if anything?
That's a really good question, and I'm sure his own people are asking that same question. What does poll well? Well, sticking up for Social Security and Medicare, that polls extremely well. So he played that card last night. I mean, the one thing he has to worry about, and he can't do a thing about, is his age. I mean, he's 80. Sometimes he looks a little frail. If he won a second term, he would be 86, leaving the White House. I mean, it's a stressful job. It's diminished presidents because of the pressure. So I think that's one thing that he can't change.
Yeah, that's one thing we can, none of us can change, unfortunately.
We cannot, no, me either, yeah.
Yeah, until we get a magic potion. Thanks so much, Greg Valere, who is the AGF Investments Chief U.S. Policy Strategist. We appreciate the time this morning.
Great. See you soon.
See ya. Let's get to today's morning brief, written by Miles Udland. Amazon disease. It's what Steve Eisman, who made his name during the financial crisis, calls the investor urge to chase what they see as the next big thing. Today, the big thing is AI. Miles joins us here on set now. All right, so Miles, take us into this and the thesis behind what's driving some of the FOMO right now and where AI plays into that, perhaps.
Yeah, I mean, look, Amazon disease isn't exactly like a novel thing. I mean, analysts have been saying, oh, what's the biggest TAM? So total available market, addressable market, however you want to say it. And you just go for that. So you get a small percentage of a big market, and then you have a big company. My point here is just that when we look at what's happening with AI stocks, there can be a lot of like, what's the deal? Why is this happening at all? And I think that Eisman's comments are pretty much like, this is why it's happening. This is why anything happens. Go back in time, look at Rivian a couple of years ago. There's a lot of cars sold. What if they got 1% of them? There you go, you buy the stock. I mean, it's not really rocket science. And you know, there's like a sell side diss in here with Eisman's comments as well, which we can leave to the side. But I think it's, again, just kind of a very simple way for investors who are confused about why things become hyped to figure out why they are hyped.
Well, I also love the tweets that always, like whether it's Amazon or any other giant company right now, the tweets that say, if you bought Amazon in whatever year it was, you would be a multi-trillionaire right now. I think, you know, that sort of feeds into this myth, if you will, of these kinds of companies.
I mean, look, I think you can look at the entire batch of post-Facebook venture-backed tech companies and look at how they've performed in public markets. And I think you could say every one of them is a disappointment relative to the alleged TAM, the alleged Amazon-like opportunity that stood in front of all of them. I mean, sure, Airbnb is a big company. I think it's what, $80 billion market cap. DoorDash is fine. Peloton's done okay. Lyft, Uber, et cetera. I think relative to expectations, they're all a disappointment given what we would have said in what we were saying in 2017, 2018.
Miles, you've been doing this for a hot minute here. What ends this activity? Is there just something people should be looking out for?
I don't think anything ends it. I think this is just like the framework. I mean, the point of a columnist is you take two different things and you say, here, these two things mean this one thing. So when there are these manias, basically, this generation of investors is going for this idea. When you say, I don't understand why everyone is buying X, I think you can pretty much back into, well, they think there's an Amazon-like opportunity. They think there's a really big market, and if these groups of companies get 1%, 2%, 3% of that market, then there's something there. Carvana, right, is another. So like, you can go through the list of every hot stock for the last 10 years, and basically this is the answer. And I don't think they're teaching anything different. I mean, every tech company is outpopulated by MBAs, so I don't think they're teaching anything different in business school either. So this is pretty much what it's going to be, probably for the balance of our careers. Actually, we'll be old, and they'll change it, and then we'll be like, I don't get it. But I just think, look, it's a useful framework.
We won't have to worry about it at that point. Hopefully, we'll be set for retirement at that point.
Retirement? You seen the stock market?
Well, luckily, I didn't start my career last year,
That's right.
so we should. Well,
That's
actually,
right.
if I had started last year, and anyway, regardless, stocks will go up over time, but that's another conversation.
Well, I mean, if we're going to live forever too, we could talk about the Metformin and the Biden thing. Like, this is hot in your household.
Yes,
so,
it is very
we'll
hot in
leave
my
that for another
household,
time.
trying to live forever.
Trying to
But
live
we
forever.
will talk about
Sure.
that another time, Miles. Thank you. So let's talk about with this current enthusiasm for artificial intelligence in the market, what the opportunity is and kind of what it tells us about where we are in this current moment in the market. Binky Chadha is joining us now, Deutsche Bank Chief Equity and Global Strategist. Binky, thank you so much for being here. We were just talking about this current mania, if you will, in the markets for artificial intelligence. Now, I know you're super high level, right? You're not digging into the names, but when enthusiasms wave through the markets for various topics, whether it be AI right now, whether it be crypto in the past, or go back to the .com bubble, right? How do you factor that into your strategy making, or do you sort of try to leave it out?
So, I mean, in terms of my official job description, number one task is to make a forecast for the S&P 500, I would say. And so, most of the companies that we're talking about are not really in there. But of course, sort of big craze and manias, they happen sort of all the time. And one question in terms of sort of a spillover of risk appetite in either direction is really about, what's basically going on. So I would say, some of the run-up very, very recently that we've seen in some of these stocks has to do with, the market getting well off the floors of basically the October lows. And so, appetite, is clearly there. I mean, we've sort of maintained all through last year and last year's sell-off that risk appetite's, pretty solid, pretty good. It was just really on the short side. And so that's all markets go down. So, markets up quite a lot basically since the October lows. And so it's sort of fertile ground to feed, these things going further, basically.
Binky, these manias we're seeing in some of these speculative stocks, do you see that activity spreading to just more structured, cash-rich, household name companies in the S&P 500?
No, I think that, our call has been basically, through Q4 and Q1, look for the market to rally, but for the market to rally basically, on a positioning squeeze, and a positioning squeeze really on the systematic strategies, which are, some of them are very, very fast moving. And I would say, the short version of the story is that the biggest driver basically of their positioning is volatility. And volatility last year was very, very elevated. Volatility across asset classes tends to have a common driver. And I think most people would agree that the main driver of volatility last year was really rates volatility, or if you want to call it that, volatility coming basically about monetary policy from the FOMC. And so what you've seen, I think, it's a simple chart that you can draw basically is take the S&P 500, use the S&P 500 equal weighted, because we do have other things happening over the course of last year, and this will reduce basically the weight of the mega cap growth in tech stocks. So take the S&P 500 equal weight and just overlay, a measure of rates volatility like the MOVE index. The overlay is pretty remarkable, and explains easily why the markets basically rallied yesterday. Because what we were hearing was, there are bumps along the road, but no reason to really get overexcited here, which is a very, very different tune than we heard all of last year. And so, if you look at what equities did, it's exactly in line with what rates volatility did. Even though rates were higher, equities were higher because rates volatility was lower.
Right. Binky, I hope my question here is somewhat simple. What's the best form of diligence that investors who are looking at some of the mania around themes like artificial intelligence, the wave of technology, especially as companies come out in droves announcing that, hey, we're going to be integrating this into our operations on a daily basis. What's the best way that they can do their own diligence, especially when there is the absence of, in some cases, regulation around that technology?
Yeah, it's not easy, as we have basically seen with what's happened in the crypto markets, and so I think that the most important diligence is perhaps your own personal diligence, where you've got to make sure that you are allocating to speculative investments in line basically with your risk appetite and your ability to withstand what happens. I think, when these companies are early and their stocks are still, cheap, in the interest of, FOMO or not missing out, taking small bets is the way that it goes. And it is only time that will tell whether they work or not.
Binky, finally, I want to turn to the Federal Reserve, because we heard once again from Fed Chair Jay Powell yesterday. He stuck to a script from last week. And I do wonder, given that he didn't push back against the rally that we saw in risk assets, are we actually seeing the market and the Fed come closer together? There had been this sort of gap in perception. Do you think that they're going to meet here?
I think Chair Powell's been very, very clear that he's not going to take on market expectations in rates, because the markets may well be pricing in a different path and perhaps a faster disinflation, and that may or may not prove to be correct. So I think the important message, after the payrolls on Friday, is that there may be bumps along the road. I'm using his expression, and disinflation is a process rather than a light on and off switch, and so it's going to take some time. I would also, take away that, he noted, basically, I would put it a little bit differently, but he noted that, the signs are clearly that we have a very strong labor market, but many measures basically of wage inflation, despite the labor market having turned out to be stronger than we thought, with the historical revisions, what you're seeing is you're still seeing, we haven't changed the wage data yet, so wage inflation's been coming down, despite the fact that the labor market turned out to be, in retrospect, a much tighter than we thought. So, there's positive news there, basically. But I would say the main message, it's the same thing happened the FOMC day, where, you saw basically a pretty good rally. Again, I would emphasize it's really been about the volatility of rates, and it is about the Fed changing the forward speed or announcing a potential change in the forward speed of moving that really raised volatility. And the behavior of rates volatility in this rate hiking cycle is very, very unusual by historical standards. And there is actually only one other cycle, which is 73-74, which saw, rates volatility rise along basically with rates. And it's not a coincidence, in our view, that that's the only other cycle which saw equities basically sell off. So I think it's really about rates vol, and looking forward, yes, rates vol has come down, but it's still very elevated. So it has plenty of room to, I would say, move down. And if and when that happens, basically, you should see systematic strategy positioning continue to move up. I'd say, it's sort of halfway up. It's up from sort of the extreme underweights to what we would say, is a moderate underweight. If you think about basically, a range, we are off the floor, but we're at the middle of the lower half of basically the range. So still has plenty of room to run.
Right. Pinky, we'll see if it does from here. Pinky Chadha, great to catch up with you as always. Deutsche Bank Chief Equity Global Strategist. Appreciate your time this morning.
Thank you.
And you saw there the opening bell on Wall Street. We do have that lower open that the futures were pricing in here. All three major averages down in the neighborhood of, let's call it, 1/3%. People still sort of sifting through, parsing through those Fed comments from yesterday, also considering the State of the Union address from President Biden and some of the rhetoric in there, and all of that equaling, for the moment, a lower market. Brad, what do you got over there at the Interactive? What are you seeing?
I've got the lower market that you mentioned a moment ago there, the Dow Jones Industrial Average right now down triple digits to start the day. We're seeing declines of about 0.3% there, about the same on a percentage basis for the Nasdaq Composite. Past 3 days, though, still net higher by a little more than 0.5%. S&P 500, you're seeing that lower by about 0.5%, but still this week net positive by about 0.2% there. Let's take a look here at some of the 11 S&P 500 sectors as we begin today's trading activity, and pulling up those 11 sectors here for you right now. We are largely in the red. XLK Technology, the lone gainer right now, the lone ranger in the green, if you will. It's up by about 0.25%. But bringing up the caboose, you've got Communication Services, XLC, down 1.5% here. So 10 out of 11 S&P 500 sectors in the red to start the day. Saz?
All right, tons of earnings still to get to this morning. Let's check in on what's trending right now on the Yahoo Finance platform. First up, CVS beat on the top and bottom lines as revenue increased over 9% year over year, driven by growth across all segments. CVS also announced they are buying Oak Street Health in an all-cash transaction for $10.6 billion. That was rumored yesterday. Now this deal becoming official. Not a solid quarter, I would say, from CVS. I'm locking in on the adjusted operating profits for the quarter, down $141 million year over year. Pressure on that retail segment, top of mind here, I think, for investors.
But the company is also coming out with a forecast for the full year that is above estimates. I think that's helping matters. You see there all of its segments seeing pretty big increases in revenue. Pharmacy services up 11%, retail up 4%, and healthcare benefits up 11%. As it does plan on closing and then digesting the Oak Street deal, as well as, remember, it bought Signify Health. It is pushing back some of its longer-term earnings targets, but the short-term ones seem to be going up.
Right, and you were talking about that health dashboard, or at least somewhat of a bringing together of all of these different brands that they are acquiring. And when you think about what that might look like in the future, they're really continuing to kind of pound the pavement on this digital experience, this health dashboard, everything from the healthcare insurance side of the equation to perhaps that just minute clinic, but through the acquisition that they just announced with Oak Street, perhaps that's where they build out that infrastructure even more so from here. So 47 million digital customers. They grew that by 7 million during this most recent year here. And so within that health dashboard, that might be where you start to see some of those services really come together.
Yeah, it's, I would say the price tag for this deal is very high for a company that is losing a large sum of money, as we talked about earlier on this one. But now I think CVS is now at a point, should you be thinking about it as a retail operation at all? I think these are now entirely different business models, and these acquisitions, there has not been any indication that they are boosting traffic to the stores, selling more candy bars, selling more stuff. So I do think over time, CVS might be looking at a situation, maybe it spins off some of these stores, like in a real estate investment trust, something to unlock value here, because this is a different company than it was the past couple of years.
Yeah,
very different company.
Big changes. All right, let's talk about another mover this morning. That is Uber, riding high following an earnings beat. Revenue was up 49% year over year as well. And the ride-hailing giant said it isn't seeing any signs of consumer weakness. For more on the numbers, let's bring in Yahoo Finance's Ali Garfinkel. No consumer weakness. How about that?
Yeah, it was quite a surprise. So Uber revenue, Julie, came in at $8.61 billion against estimates of $8.47 billion. Now, this is a beat, but again, it's the growth it represents. 49% year over year is pretty impressive, and I think it's we need to remind ourselves that this is becoming a regular thing for Uber. Look back to Q3, for example, revenue jumped 72% year over year. So what's happening here, right? In part, this is a pandemic recovery story. Even though the macro has been rough on consumers as rates are high, inflation was long incredibly high, people are still going out now that they can. Consumers have proven to be pretty resilient this quarter. We saw it, for example, in the context of e-commerce growth, but it's nowhere more clear how resilient consumers can be than in the case of Uber. Post-pandemic, folks are out, they're returning to traveling, to the office, and Uber is reaping the benefits. I'll leave you with this quote from Uber's CEO from a statement this morning that I thought was really interesting. We also reached a new milestone, crossing 2 billion trips in a single quarter for the first time, an average of nearly 1 million trips per hour. That's a lot of Ubers.
Yeah, Ali, you know what was also interesting too, just looking at trying to decode some of the stock action here in the pre-market. So gross bookings up 19% year over year, very complicated earnings release. So we're trying to make it simple. Gross bookings up 19% year over year. Their guidance for the first quarter is calling for an acceleration to 20 to 24% year over year. So that is pretty good. And also, this is a company that we've been very critical here at Yahoo Finance, but they delivered last year on their targets to finally deliver adjusted operating profits. That clocked in for last year at $1.7 billion. So there's a lot to like here. And then you have to take a step back. What does this quarter mean for Lyft?
Right, that's the question. That's one of the big outstanding questions, and I think you're right. These are complicated earnings, but they have delivered. And in this case, Lyft stock is up this morning, but I think there's still clearly pressure on Lyft because it's not just these beats out of Uber, right? There's the momentum, there's growth. Uber's leaner. There's what friend of the show Dan Ives this morning called a monster EBITDA beat. So Lyft, on the other hand, they've been trying to get there. Most people I've talked to think that Uber is taking Lyft's market share. It is eating their lunch. And Lyft has long been talked about as this little brother to Uber, right? And I think what I'm hearing is that they still have a lot to prove.
All right, we're going to be tracking both of them very closely here on this report. Yahoo Finance's own Ali Garfinkel joining us to break down Uber this morning. Thanks so much, Ali. And let's check in on shares of Under Armour, the brand that says the only way is through. Well, they're going through this morning. They're down by about 2.2%, following an earnings beat on the top and bottom lines for their third quarter, as they saw revenue increase 3% year over year. The sports apparel giant also raised its fiscal year earnings per share outlook, now expecting it to come in between 52 cents to 56 cents at the top end versus the previously expected range of 44 cents to 48 cents here. So for Under Armour, unfortunately, in this most recent quarter, though, they did see their gross margins decline by about 44.2% compared to the prior year. That's something that they also had to just let the street know about in this third quarter, 2023.
So it wasn't a quarter.
Inventory was up 50%. We love that inventory number, and so that's not a good number.
Margins were hammered 650 basis points year over year. No challenging quarter. I think the tone here is not unlike we heard from VF Corp last night. Both these companies remain in turnaround mode. Of course, VF Corp now being led by Ben Odor, new CEO there, interim still, new CEO there. New CEO coming into Under Armour. It's Stephanie Leinart. She will start soon. Longtime married executive. She's best in class, but she's got her work cut out for her. First, I think, is she has to articulate her vision to finally transform this company, and then secondarily, work some of this inventory down. That's a huge increase.
Well, yeah.
I mean, we got the shoe guy over here. Do you own any Under Armour shoes?
I do not. However, I've wanted to try out some of Steph Curry's golf shoes. He has his brand within Under Armour, of course, that they launched for him back in 2021, I want to say. But, and just to correct myself on that gross margin, it was at 44.2%, down 650 basis points, as you mentioned. But again, it's the favorability of certain brands versus Under Armour right now. What are some of
Hoka on fire.
Hoka on fire. You've also seen New Balance on the casual side start to take over even more. Nike's kind of maintained some market share there, and Lululemon actually surprisingly has been rising up in the ranks. I'm seeing that more on feed outside.
Well,
really?
Whatever. But I'm just it's the quality. You're a sneakerhead, Brad.
Yeah.
The quality. You just hold up one pair of Nikes, something comparable to an Under Armour, and you can touch and feel just the quality, and is not only that, Nike's just cooler. They've just developed this whole community around that brand, notably online. Under Armour does not have that.
You know, it's almost, remember back when people were getting their names, and people still do get their names written on their Starbucks cup. And whenever you got your name written on your Starbucks cup and it was wrong, you would still tweet it out or you would post it. And you'd be like, I can't believe they messed up my name again. It's spelled B-R-A-D. Like, how did you add 5 extra letters to it? You're still adding on to the visibility for that brand. I say that because Nike has a very similar, issue that's not an issue for them, I guess, on their hands with the sneakers app. What sneakers app does Under Armour have? They have a website. They've failed to your point, build out a digital ecosystem, I would say, in order to make sure that everybody knows from the moment they step foot in the store that they can also have a similar experience in searching online and having a community-based digital ecosystem as well. And that's what leaves a lot to be desired, I think, for investors that are looking at the shares over time. All right. Well, coming up, Yahoo Finance's Jared Blickery going to break down the latest market action following yesterday's post-Powell rally. He usually wears Vans. Today, he's got dress shoes on. Welcome back to Yahoo Finance Live this morning. Taking a look at the major averages across the board, we are seeing red. Let's get a little bit more insight and context on what's taking place early in today's tape. We've got Yahoo Finance's Jared Blickery standing by. Jared.
Hey there, Brad. Looks like we got another down day. Well, it's only early and it's only down. It looks like the Nasdaq down about 0.25%. But let me just show you what's happened over the last 3 days. I want to show some of these squiggles that happened yesterday. That was the Powell testimony, erring on a little bit of a dovish side, then the hawkish side, then a dovish close. Hard to say what's really going on there. But I think Powell's message that we could have a higher terminal rate, this could have repercussions for the market. So I just want to outline where we are with the 10-year T-note yield, and then I'll come to a couple conclusions here. This little downdraft here, probing lower levels to what, 3.3 or so, that happened on Fed Day last Wednesday, and it's been up ever since. And this is usually concurrent with a drop in tech stocks. Growth stocks don't like these higher interest rates. And then you take a look at what's happening with the 13-week T-bill rate. This is very close in terms of duration to what the Fed is doing with its benchmark interest rate. This is bumping up against that 1 month high there. that we've been seeing since late last year. And Powell yesterday, he said we might have a higher terminal rate. You'll notice that this is about 4.57%. That could be 5. It could be 5.5%. If that happens, probably going to be concurrent with lower stock prices, especially lower tech prices. But we haven't seen that yet. U.S. dollar has also strengthened, that a little bit down today, almost break even. So not much to read there on that front today. But let's take a look at what's happened in the market. This is what's happened today. Tech, energy, materials outperforming. Here's what's happened this week. Energy, tech, well, we just said that. That is still in the lead. Financials also outperforming. But let me show you what's happening with the leaders here. Software, chip stocks, momentum, defense, all of those outperforming. We've got some nice tech earnings. My point is there's a growing disconnect with what's happening with tech stocks and interest rate. And there's probably going to be that moment that they have to converge or come back to reality. So that could happen in either directions. Rates could catch up to stocks, and or stocks could catch down to rates. That's about it, guys.
Jared Blickery, thanks so much. Appreciate it. All right, Bed Bath & Beyond has seen a wild week of trading as the dying retailer aims to secure $1 billion in cash to stay in business. But worth remembering is how the company got into its current mess. That is not by not evolving with the consumer. You can see that in the company's sales. Bed Bath & Beyond is forecast to have $5.6 billion in sales for the fiscal year ended February 28th. If that number is hit, it would mark a steep drop from the $12 billion in sales the company did for all of 2018. Coming up, Chipotle CFO Jack Hartung. You see him right there on the screen. He will join us a few hours removed from his earnings call with Wall Street. We'll be right back. Shares of Chipotle are getting grilled after the company reported a same-store sales increase of only 5.6%, which was below the 7% estimate by analysts. That after the burrito giant chain hiked menu prices for the third time in 15 months back in August. Like always, Chipotle CFO Jack Hartung is here with us now. Jack, always great to get some time with you. Lots of focus on that earnings call about the price increases and how consumers are responding. Do you have any plans to dial those back this quarter to regrow traffic?
Yeah, we don't have any plans to dial the menu price increases back, but we don't have any plans to raise prices either. frankly, Brian, the last year and a half, inflation was just kind of in a, runaway kind of mode. And we were just trying to keep up with it. What we are doing, though, is we've been watching very closely our customer reaction. And most of our customers are coming the same amount of times or even more, since we've taken some of these price increases. We are seeing some softness in our lower income customers, but we're also seeing that they're spending less in restaurants generally. So it's not just a Chipotle thing.
Hey, Jack, it's Julie here. If you could, can you dig a little bit more into your input costs for us? I know that costs for things like tortillas were still going up for you. We have definitely seen avocado prices come down in a pretty dramatic fashion. How are these various input costs affecting you, and throw wages into that equation as well?
Yeah, if you look at Julie, first looking backwards a little bit, if you look at the last 2 years, our wages are up 24% and our ingredient costs are up nearly 20%. So that's the inflation that we've been dealing with. And our menu prices have lagged that a little bit. And so we've tried to keep up and we still fell a little bit short. Our outlook going forward is that we think inflation is starting to normalize, but it's still kind of in that low single digits to mid single digit kind of range. Looking forward, it looks like most of the pressure is going to come from beef. Most of the forecasts predict that there's going to be, supply not keeping up with demand. We've seen a little bit of a bump up with chicken. You're right about avocados. Avocados recently have behaved very, very well, but avocado will go through seasons, and depending on, where we're getting them from, whether it's Mexico or Peru or California, that may change. So we're pleased that it's more of I would call it a normal kind of, single digit inflation, outlook. And so if it stays that way, we don't have any plans to take any more menu price increases for at least for the foreseeable future.
Jack, I've been kind of obsessed with your Chipotle strategy and how well it's worked for you guys. And it's really in this plan to continue the expansion. And it looks like about 80% of the planned openings, 255 to 285, are going to include a Chipotle. How much more profitable are the locations that have a Chipotle than those without one for you guys?
Yeah, they're better on every single measure. When we open up a Chipotle versus a non-Chipotle, the sales are higher, the margins are higher. It's more efficient for us because more of the business comes through our digital drive-through, and that's a more efficient, channel for us. It's more convenient for the customer, and it's a convenience channel that also comes with a lot of value. Which is really important in this kind of environment where customers are dealing with inflation. So they don't have to get out of their car. So it's not as convenient as delivery, but boy, it's a whole lot cheaper. And so our customers really flock to these Chipotles, and so it's better for the customer. It's better for Chipotle as well.
Jack, I'm an avid Chipotle customer, and I've gone to a couple locations in the past 3 months, and they were out of chicken. One was out of the salsa that I normally like, and it sounded like you talked a little bit about that on the call. Menu deactivations. How widespread is this problem now, and what exactly is causing it?
Yeah, we've spent a lot of time over the last 3 months dealing with deactivations, and this really, Brian, has happened over the last couple of years. With COVID, we had things like supply interruptions, distribution trucks didn't, arrive to the restaurant on time. We've had call-offs. Our folks come in like 7, 8 o'clock in the morning to start prep so that we can open up at 10:30. If you have one call-off, you're going to fall behind on things like cutting onions, making the salsas, marinating the meats, things like that. And so all those things were hitting us over the last couple of years. Unfortunately, we kind of got into the habit of it's okay to be out of ingredients. Well, we really focused on that in the last 3 months. We've had a kind of an all hands on deck to make sure the supply is arriving to the restaurant, that, when there's a call off, you bring somebody else in, or you bring an extra person in case there is a call off, and you make sure that you are getting the ingredients into the back door, that you're prepping the ingredients so that when we open up the doors at 10:30, we have all these ingredients. We've made tremendous progress. I would say we've solved about 80% of the problems. So we're not back to 100% yet, Brian, but we've made such good progress, and we're not going to quit until, every ingredient is available every time a customer comes in.
When the ingredient supply is rattled, either on a store-by-store basis or more broadly, how do you ensure or just make sure that there is that quality assurance that consumers have come to expect from Chipotle?
Yeah, a lot of it's visibility, and, it's been difficult because there's so many, changes and interruptions that we've seen over the last couple of years. And so we've developed, just in terms of our supply chain teams, their ability to see when a truck is late, that they can respond and, at least contact the restaurant and maybe divert supply from either one restaurant or from another truck that's going to another restaurant to make sure we can get supply to the restaurants. as you guys know, we deal with, we don't have freezers. None of our ingredients come in frozen. So we're dealing with fresh food all the time. So you really have to be on this, because if you lose a little bit of time, that fresh food, if it takes longer to get to a restaurant, it's not going to be as tasty. So this is something we spend a lot of time on. And, like I said, we've solved about 80% of the problems in the last few months, but we still have another 20% to go. We're not going to rest till we get all the way there.
Jack, the garlic guajillo steak did not perform as well as you guys had anticipated because you were testing it in a different economic environment, as Brian talked about on the call. Is that going to go away, do you think? And maybe can you give us a teaser as to what other exciting stuff we can expect to eat at Chipotle this year?
Yeah, so it was always intended to be a limited time offer, and you're right. We tested it in one environment, and garlic guajillo steak it's delicious, and the customers that bought it absolutely loved it. But it is a premium item, and a premium item during an inflationary period where customers are feeling pressure with their budget. That timing wasn't great. We are in the very near future going to offer, again, for a limited time only, chicken al pastor, which is our version of chicken with a little bit more spice and a little twist of pineapple in there as well. It's delicious. So look for that coming soon. We're testing things like desserts, as well. And then we've got a menu hack that we're going to try to make available in a couple weeks now, and it's really related to having our quesadilla with steak and our fajita peppers. And so those are the few things that you can see on our menu in the fairly near future.
Well, sign me up for all of that, Jack. I
want some churros.
I'm into churros, some menu hacks, whatever you got. We're buyers here. But Jack, I also wanted to ask you about this. I was talking upstairs to my boss, Ken Underwood, and we were talking about delivery fees. We both order a lot of Chipotle via delivery, and the fees to get our products delivered has gone up a lot, and the delivery sales in the quarter fell 15%. Is there any way around this delivery network? Can you bring it in-house? Are you looking at ways to just bring these costs down?
Delivery is just really expensive. There's no way around that, whether we deliver the food ourselves or you work through an outside party. And so, Brian, we've taken the position that we're going to have all the channels that our customers want available to them, including delivery, but we're also going to price it such that, we're covering the cost. The thing we don't want to do is, for example, discount. And there has been a lot of dealing with the delivery channel to, keep those sales coming. Our model, because of the more expensive food that we buy, because we have a lot of handwork, a lot of cooking, a lot of prep going on in the restaurant, our model doesn't work if we're going to discount to get people into that channel. And so, yeah, the delivery transactions were down 15% during the quarter, but we feel like a lot of that business moved into, like, for example, especially if we have a Chipotle in that market, moved to another convenient channel, but that is a better value through our Chipotles. But the thing we're not going to do is we're not going to discount to try to get people in the delivery channel. The sales of delivery are still quite high. They're still almost, in the high teens, almost 20% of our sales. And, it's a choice that our customers that want to pay that higher price for that convenience, we're going to be there for them.
Jack, thanks as always for spending some time with us to break down the numbers. Really appreciate it. Chipotle CFO Jack Hartung, thank you.
Thank you.
Coming up, the UK is issuing a warning about Microsoft's $69 billion Activision Blizzard takeover. We'll tell you what that means for the deal overall. Next. British regulators are issuing a warning on the negative impact that Microsoft's $69 billion takeover of Activision Blizzard could have on gaming competition in the UK. Price hikes and less consumer options were among the concerns raised by the Competition and Markets Authority, which sent letters with possible solutions to both Microsoft and Activision. The companies have until the 22nd to respond. We spoke yesterday to Raymond James analyst Andrew Marek regarding possible setbacks and regulation over this deal. Here's what he had to say.
It'll kind of be a bolt from the blue, I think, when we get those provisional findings, because they do tend to be very indicative of what the final decision is meant to be. And we do believe that as the UK goes, the other large geographies like the EU and the US are likely to follow.
So, guys, we are seeing shares of Activision fall on this because of what Andrew was talking about. You know, maybe the two parties will be able to come up with remedies that the UK regulators suggesting. But I think the fact that they came back and didn't just rubber stamp it, raises some questions.
I'm starting to wonder if Microsoft really needs to even make this deal. When they announced it, Microsoft was just a bit of a different company. Now, so much focus on ChatGPT, AI movements, the rise of Bing. I mean, this is a large company to be swallowing at a time when you seem to be focusing on everything else but video games.
Yeah, well, it's going to be a while until ChatGPT can write out some game code the way that Activision Blizzard has been able to do, and do so well in the gamer community that Microsoft, in the time, let's remember earlier last year, we were seeing every type of gaming deal take place, whether that was the Microsoft Activision Blizzard one. We had also watched, oh my gosh, why is the name escaping me? Riot, I want to say, but that's, with all of the consolidation that had been taking place within gaming, it was coming on this tailwind of so many gamers that were trying to figure out, all right, how much time am I going to spend within these realms, especially if I'm not going out into the same social constructs as I was. That's dramatically turned on its head right now, and they're spending less in those game experiences. And so I think Microsoft still needs to get the deal done for titles, but that's the problem, is that Activision Blizzard has done so well in titles that it would create at least from the regulatory perspective, a competitive landscape that heavily favors Microsoft, who already has a good portion of the console market as well here.
Meanwhile, Jared Blickery flagging to us, Microsoft has just rejoined the $2 trillion market cap club.
Thank you, ChatGPT.
As it goes up 1.5% in today's session. Coming up next, BlackRock's Rick Reeder is going to join us to talk about the comments from Fed Chair Powell. Plus, we'll have a conversation with the CFO of Edgewell Personal Health on the back of that company's earnings later in the show, getting a check on the consumer.
Welcome back to Yahoo Finance. I'm Brian Sazi here with Julie Hyman and Brad Smith. Markets digesting a lot of info this morning, including a fiery State of the Union by President Biden and hawkish vibes from Fed Chief Jerome Powell yesterday. Right now, you're seeing all three major indices slightly in the red. Dow down close to 50 points. Now, here's what's on tap this hour. Markets on edge, we'll chat with BlackRock's top investing mind, Rick Rieder. And the demand for shaving cream and suntan lotion, the CFO of banana boat maker Edgewell stops by post-earnings. And as the economy headed for a recession, we'll get an inside look at economic trends with the CEO of a leading trucking tech outfit. Brad, over to you.
All right, thanks so much. Taking a look at the major averages. As you mentioned a moment ago, we are down across the board here. The Dow Jones Industrial Average right now, it is down by 0.25% year to date, still holding on to gains, though, about 2.9%. The Nasdaq Composite, you're still seeing that hold on to some very healthy gains here in 2023. However, here today, 36 minutes into trade, call it down 88 points, 0.7% in the red there. S&P 500, that's lower by a little more than roughly 0.5% right now. Still holding on to year-to-date gains, of course, though. And I also want to take a look at some of our trending tickers here. You've got some interesting activity, of course, taking place in Alphabet on the day, and that is one of the Yahoo Finance top trending tickers as of right now. That is down by about 6.5% as the AI wars, if you will, they start to heat up here. Of course, though, as we were discussing yesterday with one of our guests, Nina Schick, it's not a zero-sum game. However, some investors treating it as such, it seems right now. Alphabet down 6.5-ish% as of right now. Year to date, though, still higher by about 14%. Switching gears, Fed Chair Jay Powell has signaled to investors that the fight against inflation is not over as the central bank moves to a slower pace of rate hikes. Many investors are pushing back the expected timing of the first rate cut to 2024. But are market participants listening to Jay Powell or responding to economic data? BlackRock Global Fixed Income CIO Rick Rieder joins us now. Rick, perhaps you can help us answer that question. What are investors paying closest attention to?
Well, I've learned over my career that ignoring what the Fed is telling you is can be a pretty dangerous business. Listen, I think you got to take him at his word. I don't think the Fed's easing in 2023. Going to be cutting rates in 2023. The risk today is they go another 25 basis points beyond. I think they're going to go 25 the next meeting, and then they go another 25 after that. The economy's doing fine. I think people have written off the U.S. economy as it's almost definitional has to go into recession. And some of the data, including that payroll report, suggests otherwise. So listen, I think you have to build a portfolio assuming the Fed's primary objective, as you said, is they still have got to get what is elevated inflation a bit lower. So, we're managing the portfolios relative to that.
Rick, if the Fed does raise 25 basis points and then another 25 basis points after that, does that tip what you say is a solid footing economy into recession? Is that like sort of what it pivots on?
No. So I think people underestimate, first of all, employment in this country. If you look at the jobs report from last month, you're hiring people in education, healthcare, nurses, certainly managed care. You're hiring people in restaurants, in hospitality. We are so far below the level that we still need to get to from pre-pandemic for those jobs. And you think about a lot of those jobs, they're not cyclical, they're not interest rate sensitive. Hospitals hiring nurses, schools hiring teachers, those are not cyclical. So I think people underestimate, we're still at, we ran the numbers, we think we're over 800,000 people still in deficit in those roles. So but what's happening is inflation is coming down, like the chair said. He said, we're disinflating. You see that in the goods sector. And we're still keeping a lot of people employed. That is nirvana. That's an economy that is, you want that to happen. And I don't think the Fed should kill that, and I don't think they will. Keeping rates this high or going much further, then I think you start to impact the interest-sensitive housing, commercial real estate, auto finance. So I think you get to a level, whether that's 5.25, maybe you have to go 25 more, leave it there for a while, let it percolate through the system. The economy will moderate. And I think the Fed will achieve its goals. And it doesn't mean we have to go into a deep recession to achieve it.
Rick, as a markets veteran, I'd love to get your thoughts on this mania we're seeing in AI stocks. Do you think the Fed caused this by suggesting last week that they may pivot on rates?
Well, that's a good question. I don't think so. By the way, you can go back a year and think about the incredible speculation in meme stocks, in crypto, et cetera. There's no doubt, including leverage, that builds alongside of when you keep rates too low for too long. There's no question that's the ultimate evolution from that. This, I think, is something a bit different. We could argue, are people speculating, but the sheer size of the market and the opportunity set for some of the big tech companies and some of the companies that are in the space, you see it in semis, et cetera. It's a pretty big evolution of where commerce is going to go. Question is, in some places, is it overdone because people all flow into the area at once? But I don't think this one is akin to what happened last year. That was clear speculation and overzealousness.
And what about the zealousness, perhaps, within crypto early on to start 2023, Rick?
That is a tough one because, listen, it traded off a lot. I think people have gotten a sense, we're worried about, the delevering that was happening, the entities, the number of coins that have been built up, the gearing that was built around it had to be unwound. And now you're seeing a lot of it come out. And so there's a bit of stability on the backside of it. So I don't know. That's a tough one to think through, should it be here or a bit lower? But again, I wouldn't put that one so much to policy. Last year, definitely, when we saw levels that were extreme and the leverage that was building around crypto, that to me was a clear derivative of the fact that policy was too easy for too long.
So, Rick, let's get back to your bread and butter for a second in stocks and bonds. You sound pretty bullish to me when you're talking about the economy, the Fed outlook, et cetera. How is that flowing through to your strategy right now?
So, by the way, I didn't mean to give the impression. I think stocks are okay. The multiples are not building in any, quite frankly, any recession prospects. So I think the equity market is okay. Do I think it'll do its job and maybe hit a mid to high single digit return this year, which, by the way, has done a lot of that already? I think they're just okay. What I'm very bullish about is you can now build income in your portfolio. The 2-year note, we're back to 4.5. You can put some spread on a portfolio, with rate volatility coming down because the Fed's going to be on pause for a period of time. You can build a portfolio and create a 6 in fixed income without taking a lot of credit risk, without taking a liquidity risk, without having to go way out on the yield curve. That is super exciting. You don't get many times in your career that you can build a 6 and sleep well at night. And that I'm really bullish about. Can you create a 6 that maybe, with some tactical opportunities in places like emerging markets, can you create an 8 or 9, without taking a lot of risk? That's pretty exciting. And that's, you talk about something that's really different than coming in the beginning of 2022. This is for like you say, a veteran fixed income investor. This is exciting stuff. This is as exciting as it gets.
Rick, everything you just said is more exciting to me than any of this AI stuff. Maybe that's just, I'm a little bit of a veteran too. I'm just saying.
I think it is. By the way, now you think about the difference from last year. You can now do some things to hedge your risk because interest rates now, people will anticipate maybe the Fed will have to start easing sometime in the future. All of a sudden, equity volatility is lower. You can use some hedges in equities. The dollar is not just on a straight line up. It's starting to move with growth. So all of a sudden, you now have ways to manage portfolios that you didn't have last year. So again, like a lot of stuff that makes you feel better about investing is happening in 23 versus 22.
All right, we'll let you get back to your day job. BlackRock Global Fixed Income CIO Rick Reeder, always nice to see you. We'll talk to you soon.
Thanks for having me. I appreciate it.
All right, watching PayPal shares ahead of its February 9th earnings report. Citi analysts are cutting their 2023 and 2024 revenue forecasts on PayPal before the results, citing mixed earnings out of MasterCard and Visa. Says Citi, PayPal stock is up about 16% year to date, and a crisply executed earnings call matters to continued momentum in our view. Coming up, eBay is joining the growing list of companies enforcing job cuts. Julie is back with more on that and other top headlines next.
Yo, check it out. After the Disney earnings call ends, that's when we go live. Brad Smith here with Shauna Smith, no relation, but of course, Yahoo Finance family. We're gonna be breaking down what the tone, what the vibe of the call is. Of course, anything on streaming, all things Hulu, all things Disney Plus, and all things ESPN Plus.
I'm gonna be looking for any cost-cutting measures, talks about layoffs, what exactly that looks like. And also, this is Iger's big return. They've called in the GOAT, lots of anticipation.
Quick, favorite Disney movie?
Oh gosh, that's a toss-up. I'm gonna go with Moana or The Lion King.
Done deal. Oh, I'm going Aladdin. Yo,
There
you can check
you
us
go.
out. After the Disney call ends, Yahoo Finance begins.
We'll see you then.
Checking in on some other headlines we're watching now. eBay joining in on the layoffs spreading across the tech industry. The e-commerce platform set to cut 500 employees globally, representing 4% of its total workforce. The CEO saying employees will be provided with transition packages, including severance and incentive payments. eBay says it's looking to invest and create new roles in high potential areas, new technologies, customer innovations, and key markets. So like many other companies in tech laying people off, they're also doing some hiring. Shares of Adani Enterprises on the mend from its recent sell-off, rallying 20% as it makes moves in easing debt concerns. Adani's ports unit has committed to improving its debt ratio, that news being seen as a bright spot. Another potential sign of encouragement for the group coming from reports that Oaktree Capital Management is one of the distressed funds buying Adani's debt in recent weeks. That's according to Bloomberg. This all coming after a scathing report from Hindenburg Research that at one point erased over $100 billion of equity value. And shares of Manchester United are jumping on reports Qatari investors are planning to make a bid for the English Premier League club. According to the Daily Mail, the bid would come from individuals looking for a full takeover. The club is owned by the US-based Glazer family. They've been looking for sale at the right price. And in other news as well today, 2 days have now passed since that earthquake that devastated parts of Turkey and Syria. The reported death toll has now climbed to 11,000. Nations and aid organizations around the globe have offered help, though there are complications, including conditions on the ground and the years-long civil war in Syria. Michael Thatcher, Charity Navigator CEO and president, is here to provide some insight on the inner workers of getting aid to current crisis. And of course, Charity Navigator gives sort of a rating system for people to look at different charities and how they would like to try to contribute to help with this crisis and with so many others. Michael, thank you so much for being here. As I mentioned, there are some complications here. There's the war in Syria. There's the border, which is tricky between Syria and Turkey. What do people need to know as they are trying to sift through and figure out how to get aid to where it's needed?
It's a great question, and I think one of the challenges with any disaster is the complications on the ground. We're dealing with a situation of incredible turmoil. We've created a list at charitynavigator.org/earthquake, which has a list of highly rated organizations that are experienced in disaster recovery that will address the needs on the ground. The other important thing about this list is if you give money, you know the money's going to the disaster, not just general operating funds. And then also really important, they've got boots on the ground, they're actually doing the work.
Are we getting a sense of not just, I mean, of course there's an economic toll in any of these disasters that take place, but how much is really needed at this point to help from people who are willing and are donating right now?
I think the thing to think about with a disaster is that it happens instantly, but then it lasts for years, right? The cleanup from this earthquake, particularly in this part of the world, it's going to take several years before they're actually back on their feet. So making donations now when there's a tension, that goes to organizations that will be there for the long haul. So it really does make sense to donate now, but it also makes sense to think about if you really care about this part of the world, sign up for a recurring donation. Use your credit card, take a monthly amount, take a smaller amount out, and then have those funds going into the long-term relief effort.
Michael, I'm also curious when something happens like this and there's so much devastation on the ground, sort of the mechanism of actually getting the aid there. How does it work, right? If I give money to an organization, how quickly does it even go to work over there? How does the whole process kind of happen?
It's a great question. And what ends up happening is organizations, some of these particularly the larger organizations, they have teams that are ready to deploy, almost like the military in the sense that they're ready, they can get into the ground. They also have relationships built with a lot of governments, because that's the other part is that Governments are generally coordinating the relief efforts, and then the aid agencies plug into that. You want to find an organization that's done this before, because that's not self-evident.
Michael, how can one spot any fraudulent activity or just avoid scam-like things that will pop up inevitably from this?
It's a heartache that people are taking advantage of a terrible situation like this. We have 11,000 people that have died. There are one of the things to look out for are look-alike charities, people that are spoofing the name of a well-known organization. Again, the safest way to protect yourself is to go through a third-party intermediary like Charity Navigator. We don't charge any money. Everything's free. We help you find an organization. We also won't let you give to a fake charity. So it's really the spoofing that's probably the biggest risk. The other area where you can come under with it is suspicious is individuals asking. I would give to a known entity, particularly in a situation like the earthquake, because it's complicated actually getting the help to people.
How do you go about ranking in priority, at least, when those funds are received, where they get dispersed to?
So at Charity Navigator, we're looking at 4 key areas in our assessments. We're looking at leadership and adaptability, culture and community, accountability and finance, and then finally impact and results. With that, we do a scoring system of 0 to 4 stars. Our lists, particularly the list for the earthquake, it's 3- and 4-star rated charities, so the top rated organizations, those are the ones that we're actually promoting so that people can find an organization that's actually making a difference in this part of the world.
A really important role that you all at Charity Navigator are playing right now, as well as all of those involved in the recovery effort here. Thank you so much for joining us here today. We appreciate the time. Michael Thatcher joining us here on Yahoo Finance.
Thank you very much.
And coming up, we're going to speak with the CFO of Edgewell Personal Care on the back of the razor maker's results. Plus, you can stay tuned for our conversation with the CEO of RXO. That's later on this hour after its first earnings report following its separation from XPO. You don't want to miss it. Consumer products company Edgewell Personal Care, or ticker symbol EPC, they reported earnings for the fourth quarter exceeding expectations on both the top and bottom lines, driven by strong sales growth across all segments. The maker of Banana Boat and Wet Ones raised its fiscal year revenue outlook, now expecting sales to grow between 2 and 4%. Joining us now to discuss, we've got Edgewell Personal Care CFO Daniel Sullivan. Dan, thanks for taking the time here with us on Yahoo Finance. When you think of some of the catalysts for this quarter, what really stuck out to you?
Yeah, good morning. It's great to be here, and thank you. Look, I think, first of all, we're operating in largely healthy categories, and that's been the case certainly in the U.S. for the better part of the last year, and we're taking advantage of that, obviously. So that's one. I think, two, we've got healthy brands, and we're executing really well at shelf. Our distribution outcomes across the portfolio have been very strong. These are brands that consumers know and like and appreciate. And that's obviously been a catalyst. And then thirdly, look, there's been pricing that's been brought into the category. We've participated in that as well. All of those are the tailwinds that, yeah, you mentioned it. We were quite pleased with the quarter, 3% organic top line growth. And that was our 7th straight quarter of year-over-year growth.
Because of the higher prices, Daniel, do you see consumers buying fewer razor blades, fewer replenishment razors, trying to push some of these products to the edge of how long they should be used?
No, we haven't seen that. I mean, look, first of all, we operate in categories that are largely non-discretionary, right? They're personal hygiene, they're part of daily regiment. We also operate largely at the mid-tier within pricing across the categories in which we compete. And so we haven't seen consumer behavior. We've seen elasticities actually below historical levels. We haven't seen signs of trade down. Now, the interesting thing is within shave, we're the only supplier that actually participates in all areas of the category. As a branded business, we participate also in private label, we participate in disposables. So if the consumer does start to make trades and maybe shift down from a price point perspective, we're well positioned to succeed.
And it's Julie here, just to put a fine point on that. So you're not yet seeing that are you guys gaining any market share, for example, in this environment already? Are you seeing any signs of that in various categories?
Yeah, we held share, Julie, for the quarter across our total U.S. portfolio, which was a good outcome for us. We gained share internationally in many international markets, including Germany, which is an important market for us. We held share in Japan, where we're the market leader. And so overall, again, I think we're seeing healthy consumption right now across the categories. And we estimate that we're holding or gaining share in about 75% of our portfolio.
And if you're gaining share internationally, that's good news at a time when the dollar is coming down a little bit from its highs, right? So talk me through the currency effects as well, and what you have seen, what you expect to see this year, how much of a lift that could give to you guys.
Yeah, look, it's a volatile currency market for sure. Just when you get on the other side of inflation, you're met with a strengthening dollar. That seems to have eased. Now, that'll take some time to work its way through. A lot of that will be trapped in inventory until we move the product. But you did mention we took our guide up to 2 to 4% on the top line, largely as a result of the easing of the dollar. I think the important thing is to actually also look at the business on a constant currency level. I think that's the best indicator of performance. And our outlook this year, constant currency, is for 8% EBITDA growth and 12% EPS growth.
Daniel, I was in Target recently. I go down to the consumer products section. There seems to be a lot of just new stuff, new creams for your face, new razors, touting new blades. What's your whiz-bang product innovation this year? Do you have like 1 or 2 products that you think can cut through this clutter?
Yeah, I'll give you a product and a brand. I think the brand itself is the Billy brand. We bought it a year ago. We launched it exclusively at Walmart in this past fiscal year. It's now making its national retail launch with tremendous theater and in-store activation. It is the disruptor of the category. It gained a 17 share at Walmart in 1 year, so we're quite excited about that. I think from a product level, you look at this consumer behavior around do it yourself, do it at home, particularly on the female side. That insight has led us to be quite active in new product development. Dermaplaning, big idea for us. It was the fastest growing product on Amazon.
Daniel, real quick, because it's funny you mentioned dermaplaning. One of our producers here actually wanted us to bring that up with you. What drives that? I've never even heard of it before.
I do.
Yeah, I think it's largely come out of the pandemic, where I think women now hesitant to go back into the salon. Again, picking up on that sort of do-it-yourself, do-it-at-home spirit. So dermaplaning, big idea. We've added now waxes and depils into the assortment. And now you start to really think about it less as a shave category and more as a grooming or hair removal category, and these products make total sense.
Look, I agree, Daniel. As a person
Women
who,
and Brad.
Yeah, as a person who cuts his own hair many times, it does help quite a bit. Just lastly, while we do have you, I was noticing within the margins as well, you were talking about some of the gaining share and the consumption habits. Has any of that come at the rate of kind of sacrificing the margins where you're seeing consumers opt for a lower price as you're even taking more share?
No, we haven't. It's a great question. I think we've been pretty proactive in price. Where we're market leader in categories, we've led the market in pricing. In many places like shave here in the U.S., where we're number 2, we fast followed. So we've been pretty bullish. And in fact, if you looked at our margin profile in this past quarter, it was the healthiest we've been in 18 months. Essentially, the gains from pricing and cost savings, we call it productivity, fully offset the impact of inflation. That's the first time we've said that in 2 years. So we're actually quite bullish right now on the overall margin profile for the business.
All right, we'll leave it there. Daniel Sullivan, Edgewell Personal Care CFO. Thanks for taking the time. We appreciate it.
Thanks. Great to be with you.
Coming up, is it a new day for Pinterest? I sat down with the company's new CEO, Bill Reddy, and we'll have that chat straight ahead.
Pinterest CEO Bill Reddy leads the way in the social media platform's mission to building a positive platform as headwinds such as the ad market slowdown remain a concern for investors. So where does Pinterest currently stand on what lies on the road ahead? Saz has got a take on this day after talking to Bill Reddy.
Yeah, a good chance to catch up with Bill at Pinterest New York City headquarters. And really two things I think are important to the Pinterest story. One, when does the ad market turn around? And then, of course, the other one, how do cost cuts start to appear in the bottom line? But let's start with the ad market. Here's what Bill told us about the state of that.
Certainly there's softness in the market. One of the things that we feel really proud of is that, we've continued to grow faster than, many of our peer set in the market. And so while, yes, it's a choppy market overall, there's softness in the ad market, we feel like our relative performance has been quite strong.
So my hot takeaway there is that it might take a little while for the ad market to turn around in Pinterest's favor. It's not just Pinterest, of course. Meta's being hit by it, Snap's being hit, and definitely Twitter. And then the other component, as I just mentioned to this Pinterest transformation story, is cost cuts. Here's what he said.
Huge believer in theory of constraints, where I think creativity loves constraints. And so what we've been focused on is how do we drive better operational rigor that gets us more focused on the things that really cut through for our users, really cut through for our advertisers. And as we've been doing that, it's not just that we found better discipline on cost, we're getting to better product outcomes for our users and advertisers. And these two things, sometimes people think of these things as being at odds with one another. I actually think if done properly, they are enhancing one another.
And it's one thing to hear comments like that on an earnings call, an earnings press release, but when you spend time with these executives, I did get the sense reducing costs and complexity in that business is really, it's a big focus of his, not just for the first quarter, for the balance of this year and probably looking to 2024. And then ultimately, if you're looking to get involved with this stock in some ways, I tried to boil it down, things you should be looking for. The upside here is, of course, cost cuts, outlining double-digit declines in cost cuts in costs or expenses, I believe, for the first quarter. That's a good thing for Pinterest. New $500 million stock buyback plan, joining the likes of Meta, which uncorked recently a new $40 billion stock buyback plan. And then also focus on being a positive social media platform. That is also top of mind for Bill, which he really hinted to me that might help them take more business because of all the toxicity of going on, definitely on Twitter and then definitely on Meta. Now, some of the bad things or things to watch here on looking at the bear side here, ad market winter. We saw Mark Mahaney put out a good note on the social media players this week saying there's an ad market winter, and of course that is proving to be correct. Are more cost cuts needed here given that ad market slowdown? And then how shoppable does the Pinterest platform become? Bill has extensive background, spending many years at PayPal, spent many years at Google. He has been brought in here not only to just drive down expenses, create a better way of thinking, but also make the site more shoppable to the next generation of consumers. Ultimately, my take is this. I do sense he's the right leader at the right time in Pinterest. Bill, 43 years old, long-time executive, lots of energy, and just spending some time with him, I think he really gets tech, gets it in general, and might be the person to finally bring this platform to its true vision.
Look, I enjoy the Pinterest platform. I do a lot of discovery, kind of just looking and doing a general search on what I might be interested in. And I think the results are really timely. I don't like that I have to kind of create an account to hop into every single board all the time, but that's me just being reluctant to creating a Pinterest account, I suppose.
Indeed.
Yeah.
Yeah, I don't have strong feelings when it comes to Pinterest. But all right, coming up, our earnings coverage continues with the CEO of RXO on the back of its first earnings report as a standalone company after its spin from XPO. We're going to talk to Drew next. Moving on up, logistics brokerage RXO announcing strong earnings. It's first since spinning off from XPO, but investors watching for how RXO's tech-centric logistics pitch can keep momentum going as the economy potentially darkens. Joining us with more is Drew Wilkerson, RXO CEO. Thanks for being here, Drew. It's good to see you. So as you now embark on this big milestone in your journey as a spun-off public company, you talked in the call that this is sort of your favorite time of the economic cycle, if you will, in terms of the potential for the business. Talk me through that. Where are we, from your view, in the cycle? And then how do you try to take advantage of that?
Yeah, absolutely. Thank you so much for having me. When you look at where we are in the cycle, you've definitely seen a slowdown in the macro economy. And what we saw in the fourth quarter was e-commerce and retail were down. But we had a lot of other verticals that were up. Automotive was up, electronics was up, healthcare was up. So there were some strong results outside of what you saw from the overall, what is a typical peak season. As I look into what is going to happen for the rest of 2023, we're seeing a tight macro in the first and second quarter, but we've got some reasons to be cautiously optimistic as we head towards the back half of the year. Some of the conversations that we're having with our customers right now is, while it's been talks of destocking for the last 6 to 9 months, the conversation is starting to shift more towards restocking, which will be a tailwind for the industry. And for us, one of the things that's idiosyncratic to our business is our sales momentum. If you look at what we've got right now, in the fourth quarter, we closed with our annual bid revenue up 70% on a year-over-year basis, with 30% more customers. We're seeing more sales momentum than I've ever seen in my career here.
Okay, and so with the digital freight marketplace that you operate, what are you seeing in terms of the number of drivers, truckers that are able to fulfill all of the different marketplace orders that are coming through?
We've got over 100,000 carriers in our platform, RXO Connect, and we actually grew that number sequentially quarter over quarter, again in the fourth quarter. And there's a lot of reasons why carriers come to do business with. The first is our scale. We're one of the largest truck brokers out there. So an owner-operator or a small trucking company doesn't have to leave RXO Connect. And we see that in that 74% of the time when you log on to RXO Connect, you're back on the platform within a week. That tells you that for these small trucking companies, their likely next load comes from RXO. So we've got a ton of momentum in our digital adoption, but we're just getting started.
Drew, do you giggle at all this excitement we're seeing around artificial intelligence? Aren't you using this stuff already?
Absolutely, we're using artificial intelligence. It's a huge part of our business, and it is something that we've been at the forefront of integrating with some of the largest companies in the world. And it's something that we'll continue to roll out to small and mid-sized customers in the future.
What ways are you using artificial intelligence? How does that show up in the business so that even the end consumer knows the real delta?
Yeah, so there's a couple of different ways how we're using it. One is just the interaction of how orders are tendered and that customers are able to get pricing in real time. That's extremely important for customers to know exactly what's going on in the pricing in a real-time environment. So that's a great thing for us. The second place where we're using it is actually on the pricing side for the carriers. And so when you look at how we're pricing loads for the carriers, we have a lot of sophistication that goes into the algorithms that we've built, and we built our technology from the ground up over the last decade, which is allowing us to accelerate as we move forward.
Drew, you mentioned pricing. What is happening with contract pricing? You talked about a shift from the destocking to maybe starting to restock. Are you seeing a shift in contract pricing also?
You know, we said on last quarter's earnings call that we expected on a full year 2023 for contract pricing to be somewhere down around 10% at the midpoint. And we held to that on this earnings call. With what we've seen, our heaviest bid cycle is in the fourth quarter and in the first quarter. And right now we're expecting contract pricing to be down somewhere around 10% at the midpoint on a year-over-year basis. But for us, the important metric is our gross profit percentage. And for us, that operated at 18%. And it was up 290 basis points for our tech-enabled brokerage group.
Drew Wilkerson, who is the RXO CEO. Drew, thanks so much for taking the time here with us today. Look forward to checking back in the future for sure.
Thank you. I appreciate it.
Definitely. Guys, coming up, a new king of the court. LeBron James is officially the NBA's all-time leading scorer. We've got the details next on LeBron James. It is time for Cup of Time. 3 stories, 1 minute each. We start with this. A new NBA scoring king was crowned last night after LeBron James scored his 38,388th career point to become the all-time leading scorer, overtaking Kareem Abdul-Jabbar, who had held the record for 39 years and made the skyhook popular. Congratulations to LeBron James. It's also noteworthy that it's not just all about scoring for LeBron. He also is in the top 5 of all-time assists leaders in NBA history as well right now.
Yeah, hats tip to LeBron. This is an amazing achievement. But, you know, it was a little bit sad, too, Brad, because I remember when he first came out, started playing. So he has this record because he's gotten older, meaning we all got older.
Yeah, how long has he been playing for?
His first season was 2003, 2004. I was in high school.
And he's not slowing down. We scored, what, 38 points yesterday?
Yeah, he needed 36, I believe, to pass, so 38, yeah.
So wait, so how does his career and the time it took him to get to this compare with Kareem's? Well,
basketballstats.com.
Yeah, I don't know. I don't know the answer to this. Obviously, I should have done more. I should have looked up that basketballstats.com before this.
Well, both of them with the same franchise, though, too. Lakers. Yeah.
All right, President Biden touched on several key issues during his State of the Union address, but viewers had their eyes on something else. Senator Kyrsten Sinema's bright yellow dress, which you can see on there on the screen. This, of course, taking Twitter by storm. Wow.
It's a cool dress. But people thought that she was desperate for attention. I mean, I think Marjorie Taylor Greene screaming out several times during the State of the Union was, I mean, they're politicians. Of course they're desperate for attention. Then why do they go into that business? I don't know. Who cares?
You know, for all...
Like, really? Don't we have bigger things to worry about than Kyrsten Sinema's dress?
I mean, here's the thing. For the colors that are representative of different sides of the aisle, you got your blue, you got your red, and she couldn't even get the independent color right, which is actually purple, and she just registered as an
She's
independent.
so independent.
Right.
That she just chose her own color.
She chose her own yellow. One primary on us.
Give the lady a break. I'd like to see some of those men in yellow suits. Look how boring they
Yeah,
are.
oh God, there's so guys need to pick up their outfits. Go get a real suit. It looks like you get something, I don't know, $20 out of the dustbin or something. They're awful. These guys dress horrible.
That's
We
where
pay
Mitch
them
got
some
his.
money. Where our tax dollars going? Get them a real suit. Get it fitted.
All right, sticking
Depressing.
with clothing, Adidas is reportedly
Awful.
taking a hit from its partnership with Beyonce. The apparel brand has taken a $200 million hit to its annual projections from its Ivy Park clothing line. This all according to the Wall Street Journal. I just went on the site. Apparently, the new collection is dropping tomorrow, so you can't even buy this stuff on the website right now because they're waiting for the next collection. But it's interesting. She's still getting paid, according to the Journal. I think $20 million is the payout from this. But it is interesting, given other partnerships and what we've seen. Maybe she's putting less into it, right, than some of the other partnerships.
Maybe
that we've
this is
seen.
on Adidas. This company's a hot mess. Look how they handled the Kanye West drama. New CEO coming in here, and I would encourage new CEO to take a page out of Bill Reddy over Pinterest. Constraint breeds creativity. There's probably too many people on an account like this, all flipping a lot of paper and on hanging out in spreadsheets and ultimately getting nothing done. How do you not have a win with this stuff?
Well, the interesting thing too is, and I haven't been to a Beyonce concert since after this. Well, I went to one before this partnership took place. But you would think that this is a partnership that would be plastered all over that concert experience too. It is not. It is not.
Well,
at
maybe
all.
there are constraints on them.
There
being
could be
able
constraints,
to
right.
Do
Why
that.
not
Be able to
crush
sell
it with
merch
something
there.
from Beyonce? She's amazing, and which speaks to, I think, the broader problem at Adidas, again, which is a hot mess.
Yeah, maybe so. Although again, we don't know what she's putting into it either. I don't know. I feel like I need more information on this one.
I don't. I'm blaming it on Adidas.
Okay.
The anecdote.
That's weird. Sauce jumping to conclusions. Sorry. Let's take a look quickly at the market, shall we? Right now, we've got stocks that are trading largely lower. The three major averages, Nasdaq in particular, and the real interesting mover today, guys, has been Alphabet, which has been plunging. Microsoft going above $2 trillion in market value, as the market is saying that Alphabet feels like it also ran already. ChatGPT just came out, and there's already this kind of vibe.
Over the course of the show, I've received 8 Wall Street analyst notes just gushing over the state of Microsoft, and all those notes really suggest Google's in a world of hurt here. They're really behind the ball.
I think there just also needs to be some type of Venn diagram, or at least some type of rubric or table to say this is an algorithm versus this being artificial intelligence versus this being machine learning versus that, and they're all getting muddled together at this point, to the point where some of the CEOs and companies we're hearing from are just saying, yeah, we've been doing AI, when really it's something
just an algorithm?
else, actually.
Well, generative AI, which is this new phase, is quite different, as Nina Schick
But it's a
outlined to us
language,
the other day.
right.
Yeah. Anyway, well, I'm sure we'll be talking much more about this in the days to come. Rochelle Akufa is going to do a deeper dive into the Uber earnings meantime, and an analyst from Bernstein. That'll coming up in the next hour. And then later in the day, stay tuned for our coverage with Shauna Smith and Dave Briggs. They'll break some highly anticipated earnings reports from the likes of Robinhood and Disney, of course, as we've been talking about. And then, of course, we will get after the bell coverage, or after the call coverage, of those Disney earnings as well. Don't miss any of that, folks.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Acutho. Here's a look at what I'm watching this hour. President Biden's State of the Union saw a victory lap, off-the-script comments, finger-wagging, jeers, and a couple of sudden outbursts. But how do you trade around it? We break down the key points. And Elon Musk prepares Tesla's third master plan. Shares in the group have rocketed over 1,000% since the last one. So are we set for takeoff? We break down what to expect. And Satya Nadella calls it a new paradigm for search. But can Microsoft's Bing ever really take on Google? We look at how ChatGPT is changing the rules of engagement. But first, let's check in on how the major indices are faring an hour and a half into the trading day. All negative territory here that we see, though, relatively flat, though. The Dow, they're down about 99 points, about 1/3%. We also see the S&P there of 2/3%, down 30 points. The biggest laggard of the three, the tech-heavy Nasdaq there, down over 1% on the day, losing 144 points. Having that shift back to earnings after we did end up hearing from Fed Chair Powell. A little bit of that fear of missing out starting to wane a little bit, at least for some of these tech stocks. Let's also check in on what we're seeing with the Treasury market as well on the heels of what we heard from Powell. As we see here, it's still a mixed picture. The 5-year losing some ground here, down just about 1/10%. The 10-year, though, raising slightly, about 0.4%. And the 30-year up just over 1% there. Perhaps some of these recession fears starting to come out, at least from the signals that we're seeing in Treasuries. We'll see how long that lasts, though. All right, well, President Biden covered a lot of ground in his State of the Union address, including pressing the issue of inflation, providing an encouraging tone for Americans. Let's take a listen.
We're better positioned than any country on earth right now, but we have more to do. But here at home, inflation is coming down.
The inflation picture certainly a dominant topic for markets, but there are other worthy additional takeaways for investors to mull over as well. Here to break it all down is Yahoo Finance's Jared Blickery. Hey, Jared.
Hey there, Rochelle. Now, President Biden, he touched on the still pernicious inflation facing the American people in his third State of the Union address, as well as a number of other topics, some issues such as the billionaire income tax required by law, legislative action that realistically has no chance of passing. Now, Biden spent some time on the debt ceiling and the implication for averting an unlikely but still possible crisis in the U.S. But guess what? The bond market saying something otherwise. Potentially, it is the age-old choreographed circus that rears its ugly head every few years. Now, we know it's nearly always a nail-biter. This is a debt ceiling that gets solved at the last minute. But the U.S. did get so precariously close to breaching it in 2011 that S&P Global Markets, they cut their rating on U.S. debt, leading to a bear market in stocks by many measures, as well as a bond market rout. Now, last night, Biden drew some boos from a Republican about Social Security, but benefits such as those remain in the third rail of politics with no realistic change of getting revised anytime soon. Now, I mentioned stock buybacks as well. Biden would like to quadruple the new tax on them. Also talked about a minimum income tax on billionaires, but these items have virtually no chance of passing in the current legislative environment. So let's take a look at some of the charts I have here, and we'll begin with stock buybacks. Now, this is probably something that's not going to get touched in the near future, but we do have a tax, a new tax that began recently. Biden wants to quadruple it. But the fact is, even in the face of that, this is stock buybacks announced through February 1st of each year, going back to 2005. By far, the current environment is the biggest. So we are set for $869 billion of stock buybacks this year, which would be a record if the pace continues. So that is a passive buying force that is a tailwind for the market. Very important to keep that in mind this year. U.S. inflation rate, 6.5%. Elevated historically, but significantly off the boil here. And when we talk about inflation, a few key components, the Federal Reserve looks at something very, very specific. They're looking at core non-housing inflation. That's a subcomponent of this. But my point is, goods inflation, Powell acknowledged yesterday, coming off the boil, probably well underway. It's that services inflation that he needs to get under control. And then the U.S. debt limit. This is something we've talked about quite a number of times, currently sitting at about $4 trillion. As we approach that, there's going to be increasing potentially volatility in the Treasury market if the extraordinary measures that Janet Yellen is using to preserve the solvency of the U.S., if she she gets a little bit too close to that ceiling, then we could have some fallout. Now, I should also say the Treasury is depleting its reserves, its account at the Federal Reserve. So all of those funds in the Treasury account are being flooded into the economy. That is offsetting currently the Fed's quantitative tightening. A little bit wonky, but the status quo as we sit here is that we are not really tapping into those reserves the way you would think with quantitative tightening. All of this is going to change later in the year, but just a quick recap for you, Rochelle, of what went on last night.
It certainly was a busy one, so appreciate you breaking it down there for us, Jared. Of course, it's been a trying time for American workers the past few years as the labor market tries to adjust from the depths of the pandemic. President Biden used his State of the Union address to note the progress the U.S. has made, specifically highlighting the 50-year low in the unemployment rate. Here's what the president had to say to the masses.
I know a lot of you always kid me for always quoting my dad, but my dad used to say, Joey, a job's about a lot more than a paycheck. He really would say this. It's about a lot more than a paycheck. It's about your dignity. It's about respect. It's about being able to look your kid in the eye and say, honey, it's going to be okay, and mean it.
We're here to discuss the progress for workers under Biden's administration is Mary Kay Henry, International President of the Service Employees International Union. Great to have you on. So I first wanted to get your key moments from the State of the Union when you look at it from a labor perspective.
Well, we were incredibly proud of President Biden. He has our back. I sat next to a SEIU 1199 hospital retiree, Justine Corbin, and she was incredibly impressed when President Biden broke down, we have to raise wages. Employers need to stop fighting unions like they have been in airports where service workers are trying to organize, and that we need to invest in the Black, brown, and immigrant women that are doing home care work all across the economy. So we agree. We want to get to work with him and finish the job.
And so then when you look at this jobs rebound that we've seen since the pandemic and since he took office, 12 million jobs there in the last 2 years. So when you speak to members, how do they feel President Biden is doing for workers right now?
I think they experience him as understanding what you just showed, that the jobs are about more than a paycheck and we have to have dignity at work, and that it's really important to understand that workers have to have the right to join together in unions. And that's why I'm so proud that airport workers and home care workers and hospital workers were guests of members of Congress last night, because they understand that President Biden wants to work together with Congress in order to make sure those 12 million jobs get created and that the 64 million service and care jobs that are poverty jobs become living wage jobs that people can feed their families on. And that's why his case on stock buybacks and billionaire tax makes us understand that he has our backs and wants to make sure that the economy works for everyone and that no one is left out.
So then when you listen to some of the policies and his agenda coming up, I mean, what are some of the most immediate demands that you have, not just for Congress, but also for corporations?
We want corporations like Starbucks and University of Pittsburgh Medical Center to stop fighting their workers' desire to join together and have a voice on a job through the unions so they can address chronic staffing issues and wages and benefits and make sure that they are part of quality care and services to be provided. And the president spoke to that last night. He said that he can't stand it when employers are fighting unions. And he made it crystal clear that he's asking Congress to pass the Protect the Right to Organize Act and is requiring companies not to do share buybacks over investing in the frontline workers like the airport service workers.
And I want to ask you, because obviously we saw that bumper jobs number, although with some asterisks for seasonality and for certain population changes that the BLS included there. But sometimes when you see this big number, it can hide some of the disparities that are still at play here. And some of the sectors really in a lot of need of hiring. I know you highlight healthcare care workers, which covers a broad range, but also covers the issues with immigration as well and the role they play in the U.S. workforce. Tell us more about those aspects.
Yeah, our members are deeply concerned about getting comprehensive immigration reform done. and felt the president was very strong in demanding that from Congress. We had two members in the gallery last night that have temporary protected status, one from Honduras and another from El Salvador, that were working with, on the one hand, Majority Leader Schumer and a congressperson from Chicago, in making it clear that immigrant workers are a key part of the growth and stability of the American economy. And we need to make sure that immigrant workers can stay in our nation safely and avoid being sent home.
And you also highlighted what we're seeing with the care crisis. Obviously, a lot of the underpinnings that allow people to be able to go to work if you have, adequate care at home, and obviously you don't have to worry about not getting seen if you go to a hospital or something like that. How would you describe where we are in this care crisis?
Well, we have a president that understands that there needs to be hundreds of billions of dollars invested in home and community-based services that make it possible for elders and families with disabilities to stay independently and with dignity at home. And I looked across the gallery at Brittany Williams, who's a home care worker in Washington State. She has a union, has been able to raise wages, but we want that to be possible for 2 million home care workers who've been excluded from the right to organize, the Social Security system, the overtime, even sick leave. These 2 million women don't have. And so we're proud to stand with a president that sees those jobs and wants the Congress to invest in those jobs.
We certainly saw that union push in 2022 and likely we'll see it continuing in 2023. A big thank you there to Mary Kay Henry, International President of the Service Employees International Union. Thank you for your time this morning. All right, coming up, FOMO, or the fear of missing out on the next big thing, haunting investors, it seems. But could the latest trend be derailed due to Fed Chair Powell? We'll discuss next.
Instead of making the wealthy pay their fair share, some Republicans want Medicare and Social Security to sunset. I'm not saying it's a majority. let me give you, anybody who doubts it, contact my office. I'll give you a copy. I'll give you a copy of the proposal.
That was President Biden being heckled there by the House chamber. Now, you could see Representative Marjorie Taylor Greene standing up in the back shouting liar as other lawmakers booed. Now, not the kind of uproar that many were expecting at the address. For the background on that and other surprises from President Biden's State of the Union address, let's get to Yahoo Finance's Jen Schonberger. I mean, this was a lot went off script in this State of the Union here.
Good morning to you, Rochelle. A lot did go off script in that State of the Union, and that sort of encapsulated there. President Biden was widely expected to address raising the debt ceiling in his State of the Union address, but what ensued surprised. Tuesday night, the president claimed that some members of the Republican Party want to use the debt ceiling to sunset Medicare and Social Security every 5 years to renegotiate it. President Biden appeared to be referencing a proposal last year from Florida Republican Senator Rick Scott to sunset all federal legislation every 5 years and require Congress to pass each law again. House Speaker Kevin McCarthy has said Social Security and Medicare aren't on the chopping block. Many Republican lawmakers in the room expressed outrage at the president's statement, with Representative Marjorie Taylor Greene shouting, quote, liar. The episode was reminiscent of Republican Joe Wilson's outburst during President Obama's State of the Union back in 2009, when he shouted, quote, you lie. Now, during the raucous exchanges Tuesday night, President Biden announced a forthcoming plan to lower the deficit by $2 trillion over the next 10 years. Biden focused on lowering the deficit on the revenue side, while Republicans are more focused on cutting federal spending. The president called on Congress to quadruple the stock buyback tax that took effect back in January to 4% from 1% to encourage companies to invest in their growth instead of rewarding shareholders. Biden also called for imposing minimum taxes on very wealthy Americans and closing loopholes to crack down on wealthy, quote, tax cheats. The items were mostly retooled policies left on that Build Back Better cutting room floor, so-called finish the job policies. In fact, that was the refrain throughout the speech last night. Biden called to finish the job of rebuilding the economy and build on his policies over the past 2 years. Now, the president also revived a call for Congress to pass legislation imposing tougher oversight of big technology and social media companies. Biden has said the legislation should protect users' privacy by limiting how companies use, collect, and share personal data. He's also recommended limiting targeted advertising and rewriting part of the law that shields companies from liability for content users' posts on their sites. Also, Rochelle, no mention of crypto in the speech last night, perhaps underscoring that that's not a major political priority now, even in the wake of FTX's debacle. President Biden and members of his cabinet will hit the road today to sell voters on his message from the State of the Union address. The president speaking at 12 noon today in Wisconsin on economic themes from last night's speech. Back to you.
All right, thanks so much, Jen Schonberger there with that update and that recap of some of the surprises from that State of the Union. Well, we've heard from President Biden and the Fed this week while in the thick of earnings season. And of course, investors seem to be interpreting their messages as a sign of better days ahead. With the S&P, as we can see there, up about 7.66% year to date. The Nasdaq up about 14.33%, and the Dow there up about 3%. We're seeing that markets might be pricing in the end of the inflation problem, or could it be that investors just have a case of FOMO and are really getting in on the action now? Well, joining now to discuss is Hargreaves Senior Investment and Markets Analyst Susanna Streeter. Good to see you, Susanna. I mean, we saw some volatility creeping into that FOMO rally, but as we look, all three major indices still in positive territory, especially the Nasdaq. How would you characterize investor sentiment right now?
Yes, I think what's happening is that investors are clinging on to any hope that inflation really is coming down much more sharply. And that's when Jerome Powell talked about disinflationary forces taking hold. You saw recovery really on Wall Street yesterday. Now, there has been a bit of a decline so far in the session because, again, I think the focus has shifted a bit to his other comments where he said that actually the job was going to to take quite some time, well into next year, really to see inflation perhaps falling back down to target. So there is still some concern about what this will mean for the US economy. If interest rates have to be hiked a little bit more and stay there perhaps for longer. So I think that's why you're seeing a little bit more weakness seep in today. But overall, I think it is a glass half full approach rather than glass half empty.
So then, do you think the markets are pricing in the right amount of risk, given that they're also digesting what they're seeing with earnings season? Some macroeconomic warnings still ahead in some of these earnings, but do you think they're pricing it incorrectly at this point?
It is extremely difficult to assess whether or not the pricing is absolutely on the ball right now, because of course the data does tend to change, surprise on the upside and surprise on the downside. For example, here in the UK, we've had data out, or at least a forecast anyway, from the National Institute of Economic and Social Research, estimating that the UK will avoid a recession, partly because we've seen inflation start to come down and consumer confidence and company confidence and optimism begin to creep up, creating this positive loop. Now, if this positive loop, of course, can continue, that certainly could help, because if people feel a bit more confident, they're much more willing to spend. And given just how reliant both the UK, the US economy and European economies are on consumer spending, a lot hinges on that.
So then, is it too soon to say whether or not we're in a bear market trap or in the next leg of a secular bull market, or perhaps a bit of touch and go and something in between?
I think it's real touch and go right now. Look, there are plenty of glimmers of hope on the horizon. We've had the reopening of China following those really drastic COVID restrictions, and infections are easing. That certainly helped lift confidence that demand will return there. We are over an energy shock, for now at least, in Europe, partly because of really high production from the energy giants. So in some ways, we're seeing updates from those giants coming through, BP and Equinor estimating that demand is going to be strong, and cash will be flowing in, because of course gas is so valuable as we transition to renewables. You really do need it in the mix, and so that's likely to keep their profits certainly ticking over in a very buoyant fashion. I certainly think as though, at the moment, investors are reading more upside than downside right now. But still, let's remember, as I was indicating a little bit earlier, data does surprise on the downside and the upside. And as the central bank policymakers have said, they have to keep a really, really close watch on those readings, because if there's any hint that the inflationary spiral is proving a lot more sticky, and that means that interest rates will have to be ramped up even further, the worry will rise and resurge again that there could be harder landings for economies.
And we did hear, of course, from Atlanta Fed President Raphael Bostic that it could be another 25 basis point hike. It could be a pause. It could be a pause and then a hike, perhaps even up to 50 not being off the table as well. How, as an investor, do you really try and, I guess, protect yourself as best as possible, or really find the opportunities in this sort of touch and go environment?
Well, certainly, as always, it's ultra important right now that you're well diversified across sectors and geographical regions, of course, in such turbulent times, and across asset classes as well. That's, first of all. And certainly, I do think what investors are doing is not looking, backwards at what's happened. It's looking forward to try and get indicators about what will be ahead. And that certainly means reading all of this economic data and the predictions that we're getting from so many sources. But certainly diversification is absolutely crucial right now. And certainly, you've got to look at valuations, historic valuations, and there certainly could still be some resizing to come in terms of the tech giants. And I do think that there perhaps should be still a little bit more caution, particularly in that sector.
So not time to dive in quite yet. Still a lot more movement going on, as you were saying there. Hargreaves, Senior Investment and Markets Analyst Susanna Streeter, thank you for joining me this morning. All right, coming up, Tesla CEO Elon Musk set to reveal the third part of his master plan. But what happened with part 1 and part 2? We'll give you the full context next.
Yo, check it out. After the Disney earnings call ends, that's when we go live. Brad Smith here with Shauna Smith. No relation, but of course, Yahoo Finance family. We're going to be breaking down what the tone, what the vibe of the call is. Of course, anything on streaming, all things Hulu, all things Disney Plus, and all things ESPN Plus.
I'm going to be looking for any cost-cutting measures, talks about layoffs, what exactly that looks like. And also, this is Iger's big return. They've called in the GOAT. Lots of anticipation.
Quick, favorite Disney movie?
Oh gosh, that's a toss-up. I'm going to go with Moana or The Lion King.
Done deal. Oh, I'm going Aladdin. Yo,
There
you can
you
check us
go.
out. After the Disney call ends, Yahoo Finance begins.
We'll see you then.
Rules of the road. Tesla set to release its new master plan, a roadmap from CEO Elon Musk outlining where the company is headed. For those keeping score at home, this is the third iteration of Tesla's strategy, and our chart of the day shows just how the company has performed under its previous plans. Now, the first plan was implemented in 2006, well before the automaker's 2010 IPO. Now, the second in 2016 laid out plans for what became its Model 3 and Model Y cars, so a lot of expectations here. Now, Tesla CEO Elon Musk is saying the EV maker's new master plan will see a full release during its investor day. Here with more, Yahoo Finance's Praz Subramanian. Can't wait to see what happens here, Praz.
Yeah, Rochelle, you know, we knew that Investor Day they were going to talk about things like capital allocation plans, factory expansions, and that Gen 3 platform that they had mentioned, that robo-taxi car. But, you know, what I expect to see more about when we do have Investor Day and what Musk reveals his master plan, you know, part 3 is obviously we're going to want to hear more about that Gen 3 platform. You know, Musk says he wants 20 million cars made a year by 2030. That's going to require around, let's say, 12 gigafactories around the world. So I think they're going to hear more about those expansion plans and where those are going to be. Secondly, what about needed resources? How are you going to make all these batteries for these 20 million cars? You know, they talked about having a lithium refinery down in Texas. Might hear more about how they're going to acquire more lithium and cobalt and other materials, and also for batteries that are more efficient, maybe even cheaper. Storage. Where are we going to store all this energy that needed to power these cars? Clean energy, things like that. Maybe we're going to hear more about Tesla expanding the power packs that they use, these mega installations they use at utilities. Maybe more about power walls for the home, where people can store their energy at home for blackouts and for the charging the cars. And finally, where is all this clean energy going to come from? In Master Plan Part 2, Musk talked about expanding solar, expanding those kinds of installations. The company has sort of taken a step back recently and paused some of these big solar installations in the home and elsewhere. Maybe that's because they're setting up a new plan. Maybe we'll hear more about that in March. I think those are the number of things you're going to hear about, but I think that's a critical element, is where is the clean energy going to come from?
Indeed. And I'll be keeping an eye on that storage factor. I think that's one of the main things putting me off, sort of venturing into the EV space, apart from the price tag. But that'll be interesting. Can't wait to hear more about that. Yahoo Finance's Praz Subramanian. All right, well, be sure to tune in later this afternoon as a slew of earnings will be released after the bell. Our team will be here to break down what you need to know from the likes of Disney, Robinhood, and more. You won't want to miss it. All right, up next, lawmakers have dipped their hands in the stock market cookie jar for a long time, but now investors can get a piece of the pie themselves. Those details next. Over the years, lawmakers across the political spectrum have dipped their hands in the stock market cookie jar. Just last year, Congressional holdings beat the S&P 500 index fund, SPY, by nearly 18%, despite it being the worst market since 2008. Now, for anyone looking to get in on the action, 2 new exchange-traded funds just launched that track the trading of U.S. congressional members and their families. The Democrat tracking ticker will be under the ticker symbol NANC, and the Republican version will be under KRUZ. Both ETFs launched by Subversive Capital in partnership with Unusual Whales. Joining us now to discuss is Christian Cooper, Subversive ETFs portfolio manager. Good to have you, Christian. This is a fascinating concept. Of course, I'm sure it's not lost on people. NANC being Nancy Pelosi, KRUZ for Ted Cruz here. Talk about the decision to launch these ETFs.
Well, it was really the genius of Unusual Whales to begin documenting and categorizing members of Congress, how they trade, and the real absurdity behind the idea that they can do a lot of what we can't, right? And so if I were to trade ahead of the fund, or if you were to trade ahead of some of the names you cover, I'm sure there would be severe consequences. So part of that was transparency around what members of Congress are doing and how we can give a vehicle to the public to both be transparent, number one, and hopefully achieve some of those outside returns.
Now, obviously, it is tough because then we'll sort of be playing catch up as Congress men and women continue to do this. But talk about, first of all, the Nancy portfolio. What exactly is made up? What are the holdings there?
Well, it's really fascinating. As I began to look at the portfolio construction, I keep thinking that there's a PhD thesis in here somewhere, because I think of the Democrat Nancy side as holding ideas and the Republicans holding themes. And what I mean by that is the holdings among Nancy are the Apple, the Google, the Microsoft, the NVIDIA, the things that you might expect from let's call it a tech-heavy worldview, and which contrasts quite dramatically from the Republican side, or the cruise ticker, which are the themes, which are, it is gambling, it is the oil, it is the United Steel, it's Dow Chemical. So it's just a really interesting split between the two sides, that it's really hard to ignore the philosophical differences there on both sides of the aisle. So it's a truly fascinating study in what each side holds.
And what sort of inflows are you seeing into these funds at the moment?
Well, I mean, it was a monster launch. There's no other way to put it. We exceeded all expectations in terms of our volume. I'm really excited to see the retail participation. And as I'm checking volume right now, it looks like we may even beat yesterday's volume. So that's kind of what we want. We want a vehicle for transparency. We want someone to be able to own their values and to sleep at night, basically. And with the knowledge that they own either whichever side of the aisle that they're on, or they choose to own both and track Congress as a whole.
And I mean, you're very creative and mission-driven. As I'm looking at some of the other things you cover, that includes things like mental health, also some climate in there as well. How do you see the role of subversive ETFs growing?
Well, we kind of think about it as putting your money on a mission, and that has a very ESG tone to it, but we don't really wear that moniker well. We think that there's a particular worldview that is evolving, and whether that is capturing the elements of food security like we have in KCAL, or the decarbonization efforts that are underway that are probably going to be nuclear focused in the future, then we want to own those verticals. And we are building portfolios built on a changing worldview and doing it also while focusing on valuation. So that's really part of the decision-making process. It really is, what is going to be the state of the world 5 years from now? What do we want to own right now to build that long-term capital? Given the strength of the dollar, a lot of these holdings are international. So we can, within KCAL, I joke that we're using rich dollars to buy cheap fertilizer and our food security ETF. I mean, that truly is the case, but it really is a worldview driven and valuation driven second after that.
So what about for independent candidates who might be feeling a bit left out when they see these ETFs? Is there room for them? Are there plans to expand this political portfolio?
No, I think the only, unless Manchin leaves the party, I think maybe Bernie may be the only one left, but it would be a very small portfolio. It is, part of we did make the conscious decision to split up the funds. There was the opportunity to have a single vehicle that tracked Congress as a whole. But I think the idea of giving someone the capacity to own their values that align with them, and knowing that they can invest alongside their political views is really important without worrying about the ESG implications or ESG constraints of that. So no middle of the road for us. It's very partisan, just like America.
Well, there you go. A big thank you there to Subversive ETFs portfolio manager Christian Cooper. Fascinating stuff.
Thank you.
Well, prices are still top of mind for inflation-weary consumers, which we saw in earnings from restaurant giants Yum Brands and Chipotle. Yum Brands beat Wall Street profit estimates in the latest quarter as consumers remained lured in by Taco Bell's value offerings. Chipotle painted a slightly different picture, though, with sales cooling following a recent round of price hikes. Well, as food and beverage earnings continue to pour in, Yahoo Finance will speak with PepsiCo CFO Hugh Johnston tomorrow morning at 9 a.m. Eastern. That's following the company's fourth quarter earnings report. So, of course, be sure to tune in then. All right, coming up after the break, the battle for supremacy in the artificial intelligence sector is heating up quickly, and Microsoft is rolling out an old friend to help it out in its corner. We dive into that next. The AI search engine wars are heating up. Google recently announced its Bing ChatGPT competitor Bard, though users don't have access to it just yet. Meanwhile, if you're looking to try out the new Bing yourself, you'll have to join a waitlist. Until then, Yahoo Finance's Ali Garfinkel is here to give us a first look. Bing, didn't think I'd be using that in 2023.
I didn't either, Rochelle. So here's the deal. Microsoft's Bing ChatGPT crossover is officially rolling out. And I wanted to show you what it looks like because in some ways, at least, it looks a lot like the search experience we're all familiar with. So here's what the Bing integration looks like on a desktop, for example. Now, I'm going to be real with you, that's a lot of text for me. But now, on comparison, let's look at it on mobile, which is a completely different experience. Personally, as a consumer, I liked this one quite a bit better. Now, notably, the new Bing isn't available to everyone yet, and there is, as you said, a wait list. Candidly, this is still really nascent, and to that end, Google unveiled a slew of AI innovations today for its Search, Lens, and Maps apps. However, you said it, Rochelle, the ChatGPT competitor Bard is still only being tested by a small pool of users. Now, looking at this, and this is my opinion, I think it's possible we could be looking at a situation where Microsoft is the first mover, but I don't know if I feel like Microsoft or Google has gotten the user interface or scaling right just yet.
And I mean, Google is so far ahead in terms of front of mind for consumers as well. So how competitive can Microsoft really be here with Bing?
It's a fantastic question, Rochelle, because, I'm going to give you actually some numbers to really set up the uphill battle that Microsoft is in right here. So Bing's search market share is only about 9% as compared to more than 80% from Google. So if search really is the prize here, Microsoft still has an incredibly long way to go. That said, this is the first time in a long time I can remember Bing making headlines, so the search landscape could really be set up for a shakeup. However, there's also another question from Google, which is that how far can Google really push this without coming under antitrust scrutiny? Now, given how aggressive the FTC has been in cases against big tech recently, you have to imagine that's also really a concern here. So there might be a little bit of a gap to let some light in for Microsoft, but the race is on and it's still early.
We'll have to see what that means for ad spend. I know there was some concern about potentially Google cannibalizing itself if it does end up coming into this foray, so we'll be keeping an eye on that as well. Yahoo Finance's Ali Garfinkel, thank you so much. Well, Uber shares are accelerating following a 49% boost to its fourth quarter revenue year over year. And Uber CEO said despite some macroeconomic headwinds, he's more confident than ever following the results. Bernstein US emerging internet research analyst Nikhil Devnani joins us now. So Nikhil, I first want to get your take on these results. A lot of people are wondering, would consumers start to fall off as we get into this post-pandemic recovery? Not the case, though.
Yeah, first off, thank you for having me. I think what we saw from Uber today was a pretty good set of results, all things considered. It's a very tricky operating environment for a lot of these companies right now, but they continue to benefit from this shift from goods to services in consumer wallets. And, what we see in the rideshare side of the house particularly is that people are moving around again. Mobility services are in demand, growth there looks to be quite healthy still. And then importantly, too, is that the other side of their marketplace, which is the driver supply, which was such a big issue for a long time, that has also started to get better. And so that's also in a healthier position today, which is allowing them to meet the demand that's kind of sitting there. And then I think impressively, the delivery business, what we saw was that, yes, it's slowing down. Again, if people are moving around, they're maybe not ordering home as much, but it's hanging on better than people feared. And I think next to that kind of overall growth in the business, what they're doing is being a lot more disciplined on costs and managing expenses, and that's coming through in better margins for the business as well.
We certainly saw that, the mobility and the delivery business really driving a lot of the results, as well as the outlook as well. Talk about the outlook and what you think is Uber's ability to really meet some of these growth projections it's looking at.
Yeah, so what they told us was that gross bookings, which is kind of the total transaction value of consumption on the platform, that should be between $31 and $32 billion in Q1. Now that, again, I think is a little bit better than what folks were expecting. And really core mobility or core rideshare is driving the strength of that. They look to be in good shape to hit that. They were very close to that already in Q4. And so what we're banking on is just a little bit more improvement in kind of usage on the mobility services. We need delivery to hang in there. And typically, as you get into Q1 seasonally, again, weather gets better and then mobility trends improve, and that should help them kind of get there on the top line. Keep in mind, for Uber, the bigger picture goal is also the investor day targets that they outlined back in February. Now, those feel a little bit ambitious on the top line, but what we're seeing is that even though the growth might be a little bit tougher, particularly on delivery, relative to those initial kind of expectations, the margin structure of the business continues to trend better than what they first expected. And that's really what investors are keyed in on right now.
And we also saw the CEO highlighting this milestone, this new milestone, crossing 2 billion trips in a single quarter for the first time ever, an average of nearly 1 million trips per hour. How sustainable is this, though?
Look, I think for now, what we see is that it is fairly sustainable. I think that you have to believe in kind of the secular underpinnings of this market, which we do. I think there is a natural tendency for consumers to use more convenience. When you look at the penetration rates that Uber has across its kind of core regions, what you see is that there's still a lot of habit building going on. Yes, these services have been around for a while, but weekly usage, monthly usage of the platforms, there is still kind of room for that to go up. And I think, again, back to the point I made earlier on drivers, if drivers keep coming back, what that naturally does is it brings prices down because there's more supply online. And it's nice, in New York, I'm finally taking $15 Ubers around again. We haven't had that in a long time. In a world where inflation is surging and everything else is getting more expensive, it's really nice to have sort of the prices on these platforms get a little bit better. And if that keeps happening, then in turn, it should drive a bit more on kind of engagement and habituation. And then alongside that, they're also launching a bunch of new products. You may have tried, the shared product, which is coming back, or the Uber Reserve product, where you book ahead of time. Consumers are really taking to these new service types or new mode types, and that's helping drive incremental trip demand as well.
And as you see perhaps more drivers incentivized to look at Uber versus Lyft, when you look at the range of businesses that Uber continues to expand in and bring on board as well, how does that then compare to the Lyft story?
I mean, that's the dream, right? Is that that's what makes a great internet business, is that you've got more than one offering. And in a business like this, you've got more than one offering to engage the consumer, but also to engage the driver, to give them more earnings opportunities, which in turn gets the whole flywheel going and makes it more economical for Uber. I think what we've seen so far is that it is definitely helping. I think scale is part of it, but also having multiple earnings opportunities for drivers on delivery and mobility, it seems to be kicking in, because what we're seeing now is that Uber continues to take share in a lot of its core regions in the mobility business. And I think that makes it tougher for Lyft to kind of operate as an isolated rideshare only platform. And so I think what we would expect to see in kind of 2023 is, stable to maybe some further share gains by the way of Uber.
And is there any room for perhaps new entrants into this market, or perhaps a different direction that Lyft could go in? I think, do they have the cash available and the wherewithal to really make some moves in an Uber-like style?
I think when you think about the threat of new entrants, could someone come in, splurge a bunch of money, throw free rides at consumers and take share? In theory, yes. On paper, yes. But the reality is that we're probably in a new paradigm now for the market. I think the capacity for VC funds to back private rideshare companies is less than what it used to be. The appetite for big tech to come in and splurge money on a space like this is not probably what it might have been several years ago. And overall, I think it's just, as the capital cycle has turned, as interest rates have gone up, I think the players that are existing today and have kind of defined the market today are going to be the players that we have going forward as well. And then I think that applies to Lyft as well. Do they have the capacity and appetite to spend a lot more on drivers, or spend a lot more on getting consumers to come back? Look, I think, again, they also have their own margin targets that they're trying to hit. And so I think their ability and capacity to overspend on growth is not what it used to be. And what we're hopeful for is that, you've got two big players and overall competition is starting to become more disciplined and more rational.
We certainly appreciate you joining me this morning. Bernstein US Emerging Internet Research Analyst, Nikhil Devnani. Thank you so much. All right, coming up, Disney is set to report earnings after the bell today. We'll tell you what to keep an eye on next. Well, we'll all be all over Disney's earnings coming out this afternoon, but for a quick look at what to expect from the report and, of course, from the earnings call, let's welcome in Yahoo Finance's Ali Canal. A big one today, Ali.
Yes, Rochelle, a big one. And there's three things in particular that I'm going to be focused on later this afternoon. Number one is Bob Iger's overall streaming strategy, especially when it comes to profitability plans and subscriber guidance. I wouldn't be surprised if we saw Disney revise its guidance for Disney Plus. The company previously said the platform would turn a profit by fiscal 2024 and that Disney Plus would reach global subscribers between 215 to 245 million by 2024. But since the emphasis has clearly shifted away from subscriber growth, we could see an update there. Number two, I'm going to be looking for more announcements surrounding layoffs and restructuring. Disney has hinted that this is coming, but we haven't seen any concrete details. Bob Iger did reveal during the town hall last month that he will not be reversing the hiring freezes that were last implemented by former CEO Bob Chapek. So we know that cost cuts are coming. Usually that's in the form of layoffs. And then finally, number three, I'm going to be focused on Bob Iger's overall tone. This is the first earnings report that he will be delivering since stepping back into that CEO position. So what he chooses to address, and more importantly, how he chooses to address certain challenges the company has faced, that's going to be paramount for investors. And just a reminder that we're going to be diving deeper into this earnings report on our After the Call special later this afternoon, immediately following the results. You won't want to miss it. Brad, Shauna, and myself will be breaking everything down. And as you mentioned, there's certainly a lot to discuss.
Indeed. Ali, do you think he's going to touch on the activist investor angle as well, or do you think he'll sort of, can he afford to not talk about it? Will investors be looking for that?
I don't think he's going to directly address it unless he is asked about it. And it's quite possible that on the call, one of the analysts could ask a question about it. But I think right now, Bob Iger sort of sees this as a distraction. And there are other things that he really needs to dive into, other main issues for the company. And again, I'm going back to that overall streaming strategy, right? What is the plan for Disney? What is the focus? We had reports that they potentially want to license content. That's all well and good. But what does that mean for their platforms like Disney Plus, Hulu, and ESPN Plus? So I think that's going to be the focus for him. He's going to try to avoid the Nelson Peltz fight. If he can successfully do that, we will see. Again, it could come up on the call, but I do think at the end of the day, there are other things that investors really need to get a clearer picture on.
Indeed. Great stuff. We'll be looking forward to that later on this evening. Ali Canal, thank you for that update. All right, well, before we go, a quick check on markets. We see that all three major indices near the session lows for the day. We see there the Dow there off about 0.5%, the S&P down about 1%, tech-heavy Nasdaq taking the biggest dive there, down almost 1.5%. That will do it for now. I'm Rochelle Cooper, but I will be back with you at 11 a.m. Eastern. I'll see you then.